We've been anticipating an inflection point in the economy, so you're going to see some flexibility in the data.
We're not at the point yet where things are falling off a cliff, but we're definitely coming off the boil.
If you factor in the Fed policy and how the Fed will have to react to inflationary environment, that could really push growth down.
As far as the Fed is concerned, we should take them at face value. The driver for them has to be really real-time data.
Once bitten, twice shy. Most likely, I think they're going to be a bit late and a bit behind the curve here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Surveillance starts right now, live from New York City this morning. Good morning, good morning. For our audience worldwide, your equity market negative by 0.4% on the S&P 500. Kicking off Q3, polishing off the playbooks for the election in 2024. Just take a listen to some of this. BMO, politically provoked. Barclays, buy inflation protection. New Edge. The risk is that yields move higher from here, and yields have moved higher. In just 2 trading days, we've had a 17 basis point move on a 10-year.
And the focus really is on the 10-year, not on short-term rates, and this is important. Yesterday, we saw the biggest curve steepening, the biggest widening out between 10-year yields and 2-year yields going back to the beginning of the year. Raises a question, what can do well in this type of environment? The answer, nothing, except for the dollar. So people are looking at what is the playbook beyond this, if it is something that could potentially become protracted.
Beyond this, beyond bonds, we've got to talk about stocks as well. Laurie Cavasina of RBC out with a new price target for 2024, 5,700, the previous one 53. She calls it a nervous raise, and this is what she says about 2025. Take a listen to this. We think there's too much fog in the 2025 outlook to release an official 2025 price target now. We've been talking about this for a while, flying blind into 25.
And she's the one that said it's like staring into the sun at a time when potentially fiscal policy could make a big difference. Yesterday, we were talking about why there was such a reaction in the bond market. It wasn't because of the potential of just Trump winning the presidency. It was the idea of a Republican sweep. The idea that if one house, one party dominates either side of the government, that's going to be a big problem because there is no deficit reduction in sight. And the more you have actual unity to get stuff through, the more this deficit is going to increase. And it's not really going to be in sight in terms of ratcheting it back.
Right on cue, perfect time. And Chairman Powell's got to speak a little bit later. 9:30 Eastern time. Then we'll get some jobs data for you. Sort of the first sniff of jobs data for the week. It's the JOLTS job openings report. That comes at 10 a.m. Eastern time. Here's some of the reviews and on the jobs market right now. This from Citi's Andrew Hoddenhorst. The unemployment rate is on the edge of uncomfortable. Just how uncomfortable are things becoming for this Federal Reserve?
So right now we heard from Austin Goolsbee earlier this morning from Sintra, Chicago Fed president, and he basically was saying that we are on a path to 2%. If inflation falls back, that the Fed should automatically cut because by keeping rates where they are tightening. Why is he saying that? It is not because of inflation. Some people might argue, yes, it's because of inflation. It's because there are signs that perhaps the labor market is normalizing, and it never normalizes in a straight line. If you take a look at JOLTS, it's expected to come back down to the levels that we saw pre-pandemic. This is actually a point where suddenly the job openings aren't outstripping all of the unemployed people to such a degree that people can just say, this is a very, very tight labor market. It has changed. Central
Portugal is a perfect forum for this conversation to take place. So Chairman Powell will be alongside the ECB President, Christine Lagarde. You and I are talking about economic data. We're having a discussion about rate differentials. Maybe we should be talking about political differentials. This is what Kit Jukes of SocGen's got to say on this. Relative ECB Fed expectations are shifting marginally in favour of the euro, but the political backdrop on both sides of the Atlantic favours the dollar. It's the political backdrop here, the US versus Europe, that seems to matter more to people like Kit Jukes of SocGen than maybe rate differentials, what the ECB or Federal Reserve might do through to year end.
That's what we've seen over the past couple of weeks. It's been basically stagnant on the euro pair, euro dollar, and suddenly it crashed below 107 briefly. It clawed its way back in the face of political instability in the US. The why is interesting here. And coming out of a lot of the discussions that we've had, the why is that any type of tariffs will actually benefit the U.S. dollar, at least in the short run. And that any kind of sort of nationalistic tone in the U.S. will help the U.S. assets more than, say, if there was a nationalistic tone coming out of euro. Why? It is because of the reserve currency. It is because of the dominant position of the United States. Question is how long this can last. We can get into that, but for now, that seems to be the ramifications.
See that dollar strength on a screen right now. Euro dollar 107.11. We're negative by by about 0.25%. For the broader price action, your equity market shaping up as follows on the S&P 500. This morning, we pulled back on the S&P by about 0.4%. Some stability in the bond market after the sell-off for the previous 2 days. The 10-year at 445.73. Coming up this hour, we'll catch up with Joe Quinlan of Merrill and Bank of America Private Bank on election risk in U.S. markets. Jeannette Lowe of Strategas following the Supreme Court's ruling on Trump. And Claudia Sahm of New Century Advisors ahead of comments from Fed Chair Jay Powell. We begin with our top story, investors mapping out growing odds of a second Trump term. Joe Quinlan of Merrill and Bank of America Private Bank writing this. The key variable to watch is the US dollar. Will foreigners vote with their wallet per the US election, owning 28% of marketable treasuries, 32% of the corporate bond market, and 20% of US equities? Joe joins us now for more. Joe, let's talk about this. Your reaction to what happened on Thursday night and what you think it means for this market.
Well, John, post Thursday night, I was watching the dollar very carefully over in Asia and Europe, and really no sell-off here related to any political unrest here in the United States or uncertainty. You know, you were just talking, you and Lisa, about the dollar. It's what the dollar has strength. I'm surprised it's not stronger because what's behind the dollar is the great U.S. economy, the private sector, the most productive economy out there. And when I talk to sovereign wealth funds or family offices around the world, they want to own U.S. assets. And there's a preference and a premium on owning U.S. securities. I don't think that's going to change between now and the election. Some uncertainty, but no big change.
Joe, let's talk about what would happen on a Trump win. Got to go through a couple of steps here, but for the sake of scenario analysis, let's say he gets a win. Let's even go one step further. Let's say we get that red wave. I'm thinking back to 2016. A lot of people are thinking about the Trump playbook of that time, and this bond market was demanding bond issuance. In fact, the economic backdrop demanded fiscal stimulus. That's not where we're at in 2024. And if you think about the trades that worked back then, yes, yields climbed, yes, the dollar rallied, but small caps that month in November 2016 rallied by 11%. Joe, I'm just wondering if that's the trade this time around, because that's not what I see in small caps in the last 24 hours.
I mean, the small caps are still in purgatory here. John, you could be right in the sense that if you got an administration that's bent on doing things here in the United States, tariffs, anti-immigration, we're going to have to raise the bar. We're going to have to increase our production across the board, not just large cap, small cap. So it could spread, but to me, it'd be for all the wrong reasons. Nationalism, protectionism. So I think that trade it could come back, but to me, it doesn't give me any comfort because I think small caps can come back on their own, but if it's through policy protectionism, that's a different animal altogether. But I understand exactly where you're going, and small caps will have their day, I think, under a Republican sweep.
Joe, I'm wondering how far out you could actually make some sort of prediction. We were talking earlier, John raised Lori Calvasina and talking about how there just is no visibility around 2025. Do you feel the same way?
No, actually, I don't, Lisa. I think 2025, yes, the policy backdrop becomes a little more uncertain. But when you step back, look at the AI revolution, the productivity that's coming, look at the U.S. economy in general relative to the rest of the world, look at the geopolitics. There are places to put money to work. There's a premium on resources. The infrastructure build is going to continue. So there's policy fog, but I think there's opportunities to put money to work in certain sectors that irregardless, doesn't matter what's happening with politics, it's going to continue into the second half of this decade.
A lot of people were worried about valuations, particularly in some of the areas that you mentioned, AI in particular, looking at NVIDIA's some kind of 140% gain so far this year. You're seeing it kind of trade range bound over the past few trading sessions. Do you agree that it is concerning where valuations are, that there should be some sort of retracement before you feel comfortable really doubling down on those names?
I mean, to a degree, Lisa, yes, we're getting a little, there's a lot of bullish sentiment in the market, so we're careful about that, putting new money to work. But these companies are backing up these valuation with earnings growth, and we see that continuing. Is that going to continue into 2025? Probably not. Year-over-year comps are going to come down, but we're still comfortable owning this market, broadening out. We like the cyclicals. We still like energy. I like commodities. Anything related to transportation and distribution, transmission, we like that space as well. So we're very bullish on defense spending, given where we are. So, yes, there's parts of the market that could be allegedly overvalued, but this is backed up by a strong economy, good earnings, good consumption. and foreign demand coming back to you for U.S. securities.
Joe, build on that. Energy, defense. Is there some connection there between the two?
Absolutely, John, because what's the premium? The United States is energy independent, relatively speaking, but certainly relative to Europe and Asia. So you got all this demand for AI, these data centers. There's only one country really that can feed this beast, right? This AI beast in a relative way, and that's the United States, because we're energy independent. People haven't made the connection. If you want to drive data, drive AI, you need energy. Who has the energy? The United States. We're going to pull ahead because of our energy independence driving AI, artificial intelligence. We're going to pull ahead of the rest of the world. And that's what the bet people are making when they buy the U.S. relative to the rest of the world.
Joe, let's go one step. What am I buying then? Utilities, energy providers? Is it the oil producers, energy services? Where am I going for that trade?
Our equity analysts like the whole spectrum, John, but also transmission, distribution, utilities, really across the spectrum. We like renewables as well in this space. The interconnection queue, people don't talk about that. We've got to get that better. We've got to be able to take all this renewable capacity and plug it in. It's that simple, and we're missing it. So I think that's coming down the pipeline. More infrastructure on just basic transmission wires, distribution, getting this out. And I think that's a whole new ball game for U.S. competitiveness.
I want to be at the Independence Day celebration at your house, Joe. It seems like it's going to be exciting. I do think that there is a question when you talk about energy, particularly on a day like today where you do see oil prices climbing to the highest levels going back to April. And this is on the heels of both the Hurricane Beryl that's going the first one on records going back to the 1800s that really has reached that Category 5 level. How concerned are you about a potential spike in prices over the summer if there is some sort of hurricane season that is as violent as some people are worried about?
Well, listen, I would say to be short term, the spike up in prices, because there's plenty of oil out there globally, not just here in the United States as well. So, yes, that's a concern. But to me, longer term is everything we just talked about. It's the demand for electricity, EVs, data centers. So we're watching the hurricane season, in particular when it comes to insurance companies. What does it mean to get insurance and for housing and these other businesses that we've been talking about? That's a big issue. Fires, the climate change, the climate mitigation is broadening out for insurance companies. It's broadening out. It's going to affect more consumers. I think that's going to be a bigger issue in the second half of this decade that we're going to be talking about.
Brent, back in the high 80s, 87. Joe, it's good to hear from you. Joe Quinlan there of Merrill and Bank of America Private Bank. Key theme for Joe, preference for hard power, defense, hard assets, commodities, hard hats, infrastructure. What do you make of that?
That it's a nationalistic kind of agenda. We're talking about increasing defense spending, military, talking about building out your own industry. He's betting on what we've been hearing from every politician. It doesn't matter which side of the aisle they're on. And this, frankly, he's not alone.
It's a big, big theme at the moment. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg Brief and Danny Berger. Hey, Danny.
Hey, John. Headline Eurozone inflation slowed to 2.5% in June, adding to evidence that price pressures are gradually moving towards the ECB's 2% target. However, services inflation was stubbornly stuck at 4.1%. At this week's annual ECB retreat in Sintra, Portugal, Chief Economist Philip Lane said that he still had lingering questions around services inflation, and the data have yet to settle it. ECB President Christine Lagarde, for her part, said that the central bank still needs more time, with the region still facing inflation uncertainties. And the yen is hitting a new 38-year low against the dollar after sell-off in treasuries, trading above 161 per dollar this morning. Now Vanguard is predicting the yen could weaken to 170 if a BOJ decision at the end of the month fails to boost Japanese bond yields. That slide is putting pressure on the central bank to intervene. The head of international rates at Vanguard went on to say in an interview with Bloomberg that a repeat of Japan's yen buying spree in April will do little to slow the currency's tumble. And the Paramount saga continues. IAC Chairman Barry Diller is considering a bid for Paramount, according to the New York Times. Diller, who led Paramount Pictures decades ago and lost a bidding war for the company, is now said to be making an offer for control of its parent company. Paramount, the owner of CBS and MTV, has been weighing options for months and came close to a deal with David Ellison's Skydance Media before the negotiations collapsed. And that's your brief, John.
Got to say, Danny, this is becoming a bit tedious, isn't it? case for this company? You felt the same way?
I felt the same way. I was thinking like, oh, just buy it, just get over it or something. I had the same feeling.
Danny's back in about 30 minutes for an update if we have one for you. Up next on the programme, attempting to shift the narrative.
No one is above the law, not even the President of the United States. Today's Supreme Court decision on presidential immunity, that fundamentally changed.
That conversation just around the corner, live from New York City this morning. Good morning. The second day of Q3, here's the price action for you on the S&P 500. Negative here by 0.4% in the bond market, just about unchanged at 445.93. In foreign exchange, the euro a little weaker here, 107.13. Much more on the recent comments from President Lagarde in about 15 minutes' time. Under surveillance this morning, attempting to shift the narrative.
No one is above the law, not even the President of the United States. Today's Supreme Court decision on presidential immunity, that fundamentally changed. For all practical purposes, today's decision almost certainly means that there are virtually no limits on what the president can do.
So here's the latest. President Biden slamming a Supreme Court ruling that could allow Donald Trump to escape prosecution for his role in the January 6th riot on Capitol Hill. Biden's comments coming as his campaign looks to move the narrative away from last week's debate debacle, which saw a growing number of Americans question the president's ability to serve. Joining us now is Jeannette Lowe of Strategas, a Baird company. Jeannette, I've got to say, you're on the money when it comes to what you're focused on, and that's the tight Senate races that we should all be watching. And if those start to shift, maybe this president's in even more trouble than he already is. Jeannette, what are you seeing in those tight races now?
Yeah, good morning. So, I mean, it's a great point. The big thing that we're seeing coming out of Thursday is that everyone's worried about Biden being at the top of the ticket and now potentially having that debate performance that really did not change the election trajectory the way he wanted it to do. The bigger impact is what's going to happen in these down ballot races. And so one thing that's really important is that you are seeing Democratic senators who are, in general, it is more difficult to actually unseat an incumbent senator. We have Democratic senators in states like Pennsylvania and Wisconsin and Arizona who are actually currently outrunning Biden in the polls. And so I think that if you start to see those numbers really change direction over the course of the next few weeks, right now the Democratic Party is kind of rallying around Biden, saying that they're going to have him remain at the top of the ticket. But if you really start to see deterioration in the polls, deterioration in fundraising, and deterioration in the polling for these down ballot states, that's going to pose a lot more trouble for the Democratic Party come November.
You mentioned three things there: polling, fundraising, down ballot Senate races. Can we talk about fundraising? Some of the numbers that I've been seeing, Jeannette, say there's no problem here whatsoever. What are the numbers that you're looking at?
Right. So right now there is no problem. So they had pretty good numbers over the weekend for the Democratic side. They'll have to see. I think right now, they're definitely concerned that the Republicans are having really good fundraising and kind of eating into the fundraising advantage that Biden did have earlier this year. But right now, there is kind of this rallying right around him. You had the president come out and speak last night about the Supreme Court decision. This is really him trying to reframe, maybe try to get some of those images of Thursday night out of the public view and put some new images out there. So him taking that stand last night to make a statement was important for the campaign to try to reset and to try to change the narrative a little bit away from that debate performance and be a little bit more presidential. So I think that we're going to be watching those numbers. Right now, everything does seem to be okay, but I think the next couple of weeks are going to be really critical for this race.
There's some discussion of the DNC, Bloomberg reporting that the Democratic National Convention Committee is thinking of actually pulling forward the nomination of Joe Biden to try to throw a sense of support behind him. Is this the right idea, given the fact that anger is still out there, very much so, and there's a question of why the internal circle around Biden isn't necessarily being more transparent about this process?
Right. And this is something that was actually kind of planned a little bit earlier. They were thinking about doing it before August 7th, just because there had been issues with the Ohio ballot. And so the party wanted to have him basically nominated early just so that there couldn't be any turmoil at the convention in August. If you have a contentious convention, that generally doesn't bode very well for the party ahead of the actual election. And so that was something that they were actually trying to avoid. But one of the things that they're trying to do now is thinking about, okay, well, if we can actually move this forward, that would kind of solidify Biden as the nominee. You can't have people coming up at the convention trying to throw another candidate's name into the hat. But this is ultimately going to be, for better or for worse, this is down to Biden making the decision whether he wants to stay at the top of the ticket or if he wants to step down. He can do that before the convention. That could be very messy, having multiple delegates having votes to figure out who should be the next nominee. The committee can also do it after the convention as well, or we could see Biden stay in the entire time. But I think this move to potentially have the nomination done in July is a way to try to squash any dissent. If Biden can keep his numbers up over the next couple of weeks, we don't see a great deterioration in polling. If we can see him making more statements like last night than last Thursday, I think that would be something that would allow him to stay at the ticket. But this is something definitely to be watching.
Jeannette, yesterday we had a series of guests talking about how Thursday night was a game changer for them in the market, that essentially they were looking at the higher likelihood, much higher likelihood of a Republican sweep, exactly going to your first point, which is essentially you need to watch down ballot and see how many people basically stay home, are not excited about the top of the ticket, don't feel like they're being heard by the Democratic Party. How much is that something that you're seeing as a much greater likelihood today than, say, Thursday morning?
So I'll agree. I think the consensus is that there is definitely a greater chance that we're going to have a Republican sweep in this election. But I do think it is important to not assume that that would be the case. Again, these down ballot races are quite important. What we have kind of seen is that it seems that there's a much bigger problem with Biden and Harris at the top of the ticket rather than an overall problem with the Democratic brand. So you do see House races that have done quite well. You do also see these Senate races, again, where the Democratic candidates are outperforming Biden in key swing states. The other thing I think that what's important to watch is we don't want to just watch just what the polls say. We want to see actual results. So we've been watching the special elections that have occurred since January, and Democrats have been outperforming by 11 percentage points versus what happened in those districts in the last election. So that does seem to indicate that there could be some ticket splitting this year. It could be that voters might think that they could vote for maybe Trump at the top of the ticket, but then Democrats either in the House or the Senate races. The important thing to remember is that currently Congress has very tight majorities in both the House and the Senate. It will not take a lot of seats one way or the other to really move that, but there is still the possibility that maybe we don't see a Republican sweep. Maybe we actually see a divided Congress next year.
Jeannette, you get the distinct sense right now that a lot of people in this country feel like they're being lied to, like there's a division emerging between the campaign and the rest of this country. And I don't know what this campaign does about that. If I think about some of the stories over the weekend, we saw even CNN getting blamed for the makeup they used on Joe Biden as if that was the problem on Thursday night. What do you think they're going to do over the next 4 months to try and right course what we've been seeing, not just on Thursday night, but for the last 12 months?
Right. And so, I mean, I think that Thursday's debate definitely reinforced voters' concerns about Biden's age, about his fitness to continue to serve as the president. And the president really needs to try to change this race. It is currently a referendum on his first term in office. His approval rating is hovering around 40%. That is not good if you're looking to get reelected. So he really does need to change this into a choice. There are some key factors to look for in the coming days. Obviously, with the Supreme Court decision yesterday, you saw Biden's statement to try to change this, to try to say, okay, that was the decision, but I'm going to try to frame this as more of a choice between me and former President Trump. You also have Trump's sentencing coming up next week, so that's going to be an important point. Things also to watch for is who is the vice presidential pick on the Republican ticket. So there are options for the Democratic Party to try to reframe the race, to make it just more of a choice between Trump and Biden. But there already is kind of this baked-in feeling that voters have been concerned about Biden's age. Yep. That wasn't alleviated over the course of the last week, and that's something that they're going to have to figure out how to deal with.
Jeannette, this was great. Jeannette Lowe of Strategas, thank you. Up next on this programme, global central bankers meeting in Sintra as political uncertainty weighs on markets. Stocks just a little bit softer here. We're down by 0.4% on the S&P 500. Looking at the Nasdaq and the S&P, both negative by 0.5%. On the Russell, we're down by about 0.4%. The attention really on the bond market in the last 24 hours, include Friday and that, the last 48 hours of trading. The 2-year has been really, really quiet. The noise is at the long end of the curve. The 10-year yield repricing higher to 4.4554. And Lisa, just pricing in the odds, the higher odds of a Trump win. More debt supply, higher tariffs, the threat of higher inflation too. And not just a Trump win, but a sweep. And that is what we heard from David Kelly. That is what we heard from a host of different guests yesterday who came on and said right now, exactly to Jeannette Lowe's point, watch down ballot. There are going to be potentially independents who stay home, who don't want to go to the ballot. So at this point, can you start pricing in some sort of yield premium? Is this sort of a mini bond market tantrum that's sort of giving you a sense of what's to come? Or is this a blip as people try to look for an edge in a relatively edgeless world? So we get these high yields and it makes it even harder, I think, to construct an argument that the dollar's about to break down anytime soon. If you switch at the board and turn the page to the FX market, that means there's a problem in Japan. Dollar yen at 161.66. The higher the session, 161.74. We'll talk more about Japan in just a moment. And over in Europe, we've got the euro at 107.17, negative by 0.2%. So we've got dollar strength across the board, 3G10, including the Japanese yen. And even when we start to talk about rates, Christine Lagarde of the ECB is opening up Sintra Portugal, their big ECB forum, talking down rate cuts in 2024, talking down rate cuts for this month at least, for the month of July. It's not doing much to buy much in the euro, is it? No, especially at a time when we see the Eurozone inflation come down pretty much in line to 2.5% in June. That's basically getting closer to that target. You have some discussion from other ECB officials saying, well, I'm not ready to call out any kind of additional rate cuts. She's trying to have a more hawkish message. The market is saying, frankly, it doesn't really matter because if you look at the politics in your region, the politics in the United States, the strength in the United States versus the weakness that we're seeing in parts of the euro, we're not buying it. Isn't it funny how it adds up, though? We talk about political risk in France, higher debt issuance, not doing things about the deficit, yields are up, spreads are wider. That's a euro problem. We talk about almost exactly the same thing taking place in the United States. That's a euro problem. It's like the dollar wins, either way. And this sort of goes to this question that you've been asking for the past, 6 months. At what point does the U.S. lose the privilege of acting recklessly in terms of borrowing? And the answer is not yet, and probably not in the future, because what is going to replace it at a time where there is this engine of innovation in AI, in technology, and that's what a lot of people keep pointing to. Not the euro, that's for sure. 107.17 on euro dollar. Under surveillance this morning, President Biden slamming a Supreme Court ruling that found Donald Trump has substantial immunity from criminal prosecution for actions taken while in office. Biden's televised remarks coming as his campaign looks to shift attention away from last week's debate debacle. And they're struggling to do just that, Lisa. And if anything, if you're in the market right now, you might believe that the decision that came out yesterday morning just feeds even more life, breathes even more life into this campaign of Donald Trump this year. Because it's unlikely that he's actually going to be put on trial for some of the other existing trials before the election. So at this point, that's not going to be as much of a distraction as maybe Joe Biden would like. Look, there is a bigger question, and it's something that I have felt pretty consistently over the past few months, which is the trials and the legal issues that Donald Trump has faced haven't really moved the needle. It's not what people are paying attention to, and it hasn't been for quite a while. The people who are going to care and not vote for him as a result are not going to vote for him as a result, and the people who don't care aren't going to care, period, full stop. So the question here is, how do we sort of look at this election at a time where Joe Biden is facing increasing calls from his own party, and Donald Trump is suddenly remaining quiet because he can let the other party implode. And that's what you're seeing happen, even as there's some real questions about the legality of Donald Trump and some of the things that he did. So you could talk about the Supreme Court, and you're going to hear a lot of noise around that because there's anger around the split decision. At the same time, you wonder whether that really does anything to fundamentally shift the race. I'll agree with you by disagreeing with you. It has moved the dial. It has moved the needle. But it's helped him. It hasn't hurt him. Hasn't it, over the last 12 months? If anything, I remember the polls for the Republican primary that had the governor of Florida, DeSantis, ahead of Donald Trump by quite a margin. Do you remember those polls? I do remember those. Yeah, do you remember why they changed? Because all of a sudden, Donald Trump is back in the news flow, in the news cycle in a massive way because of these criminal investigations. He takes on this sort of martyrdom in the Republican Party. And this has really helped him. It hasn't hurt him. And still, look, here we are sitting here. If anything, Joe Biden would love, the sitting president would love to make this a referendum on the former president. His struggle after Thursday night is it becoming a referendum on him. And he can't get away from that, Lisa. And how he changes that over the next 4 months, let's see.
The problem is, and you nailed it, when you said ultimately this comes down to a feeling of honesty and whether people feel like there is a transparency. This from the Financial Times, from a Democratic operative who has been in the market for a long time. There seems to be a level of anger, and this is within the Democratic Party, that the inner circle has been keeping things from all of us. This is the issue. You can't turn the page on a fundamental feeling of distrust. And that has to be addressed directly. And if it's not, you're going to have these existential questions heading into November.
Forgive me for playing political pundit on TV for another 2 minutes. Political elitism does not work in global politics. This is where the party went wrong in 2016 with Hillary Clinton, failed. Joe Biden sees himself as Scranton Joe, sort of scrappy, working class, blue collar politician, and we've got to sit here and ignore the fact that he's been doing this for 4 decades. And the fact that the behaviour of the last couple of days just screams elitism. It's political elitism to sit here and say, don't believe your lying guys. What you saw on Thursday night is not what happened. And to have people come up, including the former president, and say, yeah, you can have bad debates, you can bounce back from them. You can't compare what happened Thursday night to a bad debate of Obama against Mitt Romney. That's not what happened Thursday night. It's not like they got their lines wrong. That's not what happened on Thursday night at all.
Well said. And this is what we saw at G7, and this is what we're seeing globally. There is this issue of trust us and outrage that people are saying, wait a second, hear what we're saying. And that, I think, needs to be reflected.
Without a doubt. Much more, of course, on this throughout the morning. Let's turn to the Japanese yen. Traders paying very close attention to possible yen intervention as the currency touches a 38-year low against the dollar following a jump in US Treasury yields. Japan's Vice Finance Minister saying recent moves in the currency are largely driven by, guess what, speculative trading. Those comments not helping. 161.68.
Especially at a time where you have some banks, including Bank of America, calling for the potential for yen to get to 170 versus the dollar. That's the kind of level that you could see. Or Vanguard sees the yen sliding that kind of level. If you see this ongoing lack of response from the Bank of Japan, ultimately it requires a rate hike in order to get some sort of traction underneath the yen. And in the meantime, U.S. travelers who want to go to Japan can get an incredible box of sushi, evidently, for, $12. That's what I'm hearing.
Is that the feedback you're getting?
That's the feedback.
From your tourist on the ground?
Yeah, I'm getting from color on the ground.
Amazing. 161.68 on dollar yen. Let's turn to the global central bankers meeting in Sintra, Portugal this week. We'll hear from Fed Chair Jay Powell alongside the ECB President Christine Lagarde at 9:30 Eastern Time. The meeting coming as elections in France and the UK, as well as the upcoming US election, continue to weigh on global markets. Bloomberg's Enda Curran joins us now for more. Enda, great to catch up with you, sir. What is the overarching message coming from these central bankers in Sintra, Portugal?
I mean, there's so much uncertainty, John. I think on the one hand, they want to talk about inflation. They want to give guidance about where rates might go from here. And in truth, probably most central bankers would like to cut interest rates if they could right now. But take the UK and France. We have two massive economies this week with major elections due. France, of course, so much uncertainty in terms of whether or not there's a hung parliament there or a majority for the RN. That will dictate fiscal policy, that will dictate relations with the rest of the EU. And of course, that's so critical for the broader ECB story. And it's the same in the UK. Broadly, a result expected to return a centrist Labour government, but still question marks over the growth and spending story there. So, in many ways, no matter what the central bankers say today, they know in their heart of hearts that their political masters back home are busy, and whatever way those votes turn out will dictate macroeconomic policy in the months ahead.
Which is the reason why we're dealing with the S word again. Sufficient, sufficiently restrictive, sufficient data. That's what we heard from Christine Lagarde. We are still facing several uncertainties. It will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed. We saw the Eurozone inflation rate come down to 2.5% in June, pretty much getting closer to target as expected in that region. I'm just wondering whether you're getting a better sense from the Sintra discussions around what sufficient data means, about what data people are honing in on. Is it really just the labor market at this point as people assess the turn in inflation and now potentially the long and variable lags?
I think there is a lot of focus on the jobs markets, especially in the advanced economy world, Lisa. We know in the US, for example, people here like Goldman Sachs talking about the inflection point in the labour market. We'll get more, of course, we'll get jobs out on Friday. That will decide whether or not that is the case. Similar in Europe, a lot of focus on the jobs market. But also, there's a lot of concern about policy error. The risk of moving too soon. The cardinal sin for central bankers. And look at Canada. There's been some focus on Canada among the analyst community in recent weeks. They were the first G7 central bank to cut rates, but then they had an upside surprise in inflation. A lot of people saying that's exactly why the Fed are being as cautious as they are, and of course why the ECB is trying to contain the narrative and control the market horses too when it comes to interest rates. But I think the whole backstory is, though, that most central bankers would probably say growth is slowing. They would like to be in a position where they can bring down interest rates. It's just that there are so many sticky pockets, especially in the services side of things, that's keeping inflation, perhaps just a little bit too high above their inflation targets. That's holding off any kind of near-term rate cuts. And I think that's why we've been disappointed this year. At the start of the year, it was expected to be a green light for rate cuts. Here we are at the mid-year point, and it really is proving to be much harder than expected.
There's a big question about why the U.S. has remained such a bastion of safety for people putting their money in the dollar, and why the euro is sort of punished on all counts, whether there's sort of fiscal and proprietary or questions around the political sphere, or if it's just simply that the ECB isn't going to cut rates as quickly. I'm going to throw another one in. China. There is this question around any kind of weakness in the Chinese economy. Some whiff of it we saw overnight, some of the latest data, and how much that's really one of the key pressure points for an ECB that's trying to figure out how to both support growth while counter whatever's coming from a country that it really doesn't have a lot of visibility on.
Well, I think China has a very important policy meeting on this month, the third plenum meeting. That will dictate where policy goes in China over the coming months. I can tell you a lot of outside observers will be watching it closely. Will the government there come out with a kind of a pro-growth strategy, which has happened in the past, but expectations are being fairly managed in terms of what they will do. The kind of risk is that the policymakers opt for the muddle approach and disappoint on the downside. But what comes out of that plenum in China this month will, of course, have consequences for big trading blocs like the Eurozone and the US, who do a lot of business with Europe. I think right here, right now, the bigger driver for both the ECB and the Fed is their domestic inflation story, their domestic economic story. But if we do get a reboot out of China heading into the back end of the year, that will certainly become a global factor.
Great to catch up, Enda. Appreciate it. Enda Curran down in Washington, D.C., breaking down the latest for global central bankers. Lisa brought up the jobs market. Remember, JOLTS out a little bit later. Job openings at 10 a.m. Eastern time. Also, make sure this is in the calendar. Jobless claims come out tomorrow, not on Thursday because of the national holiday for Independence Day. We're looking for jobless claims in America to climb to 235 from 233 recently. So that's in our survey. Our survey for Friday, incidentally, payrolls Friday, 200K. Is the headline estimate now in our survey, Lisa. That is down from 272 in a previous month, but 200K is still pretty punchy, isn't it, on headline payrolls?
It depends, right? It depends where the jobless rate comes in, and it depends what the neutral level of jobs created has to be to create enough jobs for this economy. I would say the unemployment rate, which is expected to stay at 4%, is going to be key. I also think that the JOLTS number is going to be really particularly important, since it's a forward look at the potential openings at a lot of different companies.
On the edge of uncomfortable, the unemployment rate, Citi's Andrew Honhorst. That jobs data drops Friday morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that the Democratic National Committee is considering formally nominating President Biden as early as mid-July. Sources say a potential date for the nomination is July 21st. That's when the Democratic Convention's Credentials Committee meets virtually. The DNC says the plan is not a response to the fallout from Biden's poor debate performance. More home buyers in Manhattan are taking the plunge instead of waiting for rates to come down. According to firms Miller Samuel and Douglas Elliman Real Estate, closings for co-ops and condos spiked 12.2% for the second quarter this year compared to last year. The median price of $1.18 million is slightly down, but that's still hovering near records. Deals closed with a mortgage were also up 15%, while deals closed with cash were up just 10.6%. And Portugal has secured a spot in the quarterfinals of the Euros after a dramatic win over Slovenia. Cristiano Ronaldo's extra-time penalty shot was saved, while Slovenia missed a clear one-on-one. Both of those chances, had they scored, would have likely proved decisive. The match finished 0-0 and went to penalties, where Portugal's goalkeeper saved 3 consecutive shots to secure the victory. Portugal will meet France in the next round after they beat Belgium 1-0. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. What a fantastic European Championships this has been. Just like underdog after underdog, taking it as close as you could possibly take it.
And the games have been incredible, I have to say. Even some of the winners that have actually been predicted, winning by a hair and really not exactly getting the victory that a lot of people expected.
See Cristiano crying yesterday?
Yes, I did.
Brutal.
I know. But
a lot
that's
of
the
people
thing he
took
does.
satisfaction in that. You know, I couldn't. I found that heartbreaking.
Yeah, no, I get that. It's sort of, it's embarrassing.
It made up for it in the penalty shootout anyway. Embarrassing.
Well, it's like, you know, you need to sort of be there for your team and kind of keep it together.
Of course, I agree with that.
Have composure, and you don't want to be completely losing it.
It's all about him.
I get it.
I get it too. Up next on the programme, warning signs emerging.
Usually, as they describe, unemployment goes up like a rocket and comes down like a feather. And so that's on everyone's mind. The job market is still quite strong. It's just been some warning signs.
We'll talk about those warning signs next on the programme. Live from New York City, this is Bloomberg. Live from New York, welcome to the programme. Equities right now on the S&P. Your scores look like this. We're negative by a third of 1% on the S&P, pulling back from yesterday's gains. In the bond market, yields lower too after pushing higher Friday and Monday, but down a single basis point, 444.74. More economic data coming up a little bit later. In the FX market, dollar strength against the bulk of G10, including the Japanese yen and the euro. Euro dollar 107.16. Under surveillance this morning, warning signs emerging.
In the Fed's dual mandate, we've been doing great on the employment side, and we have done far less great on the inflation side. But now inflation is coming down, so we got to think about both sides. Usually, as they describe, unemployment goes up like a rocket and comes down like a feather. And so that's on everyone's mind, that there are some warning signs in the job market. The job market is still quite strong. It's just been some warning signs.
It's the latest. Fed Chair Jay Powell speaking at 9:30 ahead of a busy week of labour market data. Jolts coming at 10 a.m. Eastern time this morning. Jobless claims tomorrow and the main event, the payrolls report, coming on Friday. Claudia Sahm of New Century Advisors writing this. A good labour market is not a reason to wait. The reason to cut is that inflation is down considerably. A good labour market is what's at risk if the Fed doesn't. Claudia joins us now. Claudia, that is just fantastic framing. Can we just talk about how good this labour market is at a time where there are some question marks around it?
It's good. I mean, we are going to, in all likelihood, have another jobs day that is a day worth celebrating in general. We've had very strong payroll gains for years now into this. We've had the longest stretch of low unemployment since the 1960s, and we continue to have months of wages outpacing inflation. This is exactly what the labor market needs to be doing to get us back to a more balanced, normalized place and to deal with a lot of the harmful effects of the high inflation we have had already. So, I mean, this is really a good thing. And yet you can have two things be true. We have a good labor market and it is weakening ever so slightly and gradually. We need to pay attention to both sides of that.
Claudia, you know what's amazing? When we catch up, I hear other people talk more about your role than you do. And I just wonder what you think about that. They're all citing it. They're talking about the next number, 4.2%. Then we've got a problem. What do you caution people with when you hear people talk about the rule that you came up with?
There is no simple solution or simple rule to assess what's going on in this very complicated world. Like, the rule had a purpose. I stand by the Sahm rule. It has a logic. That's why I talk about we need to look at this gradualing of the labor market. And yet it's not to hang our hat on. And I absolutely am uncomfortable with people thinking about it as, oh, that's going to tell us we're getting too close to the edge. No. See, the Sahm rule, it tells us we are in a recession. Right? If the Federal Reserve were to wait until the Sahm rule triggered, they have waited too long, right, in terms of getting ahead of a recession. So it's about how we use the tool. And there's a lot of... It's really complicated right now to read the labor market. We saw that in the last jobs day. A lot of measurement, a lot of the immigration is playing a big role. That plays a role inside of the unemployment rate and the Sahm rule as well. So to say this is a recession or we're really, really close to one, that could be. but we don't want to be complacent about the other stories that are in the mix.
At the same time, Claudia, are you really interested to see the actual unemployment rate almost more than the headline number on Friday, just simply because it's more of a gauge of where the labor market is in a way that maybe the headline numbers don't give, given some of the influx of immigrants?
I mean, the unemployment rate, if you have to pick a summary statistic out of the labor market, that's the one to go to. And yet it's this really great thing. We don't have to pick one. Right, like we absolutely shouldn't in terms of looking across the different pieces of information we have, and not just the labor market, how it fits with the inflation and the consumer spending. Like this all comes together. That makes it much, much harder. We cannot boil that down into a rule. And yet I take very seriously the labor market has weakened. And if you look, it is a gradual weakening that is not just the last few months. This has gone on for over a year. We have seen a drift up in the unemployment rate, and to have policymakers like the Fed with forecasts written down of, oh, the unemployment rate is just going to stay at 4% the rest of the year. And it's like, how exactly do your high interest rates do that? How do they stop a cycle? So I take it very seriously, and it is an absolute risk that I'm concerned about. And yet it's a risk that policymakers, the Federal Reserve, can still react to if they so choose. But they need to react. That window is closing to get ahead of that risk.
How big is that window, Claudia? Can you put some sort of time frame on it?
We talk a lot about the Fed working with lags, the monetary policy lags. Those lags, we don't tend to talk about them in the real economy, not financial markets, but in the real economy. Those are in terms of quarters, multiple quarters of the interest rate changes to take effects. So again, you can't, whereas financial markets may turn on a dime if the Fed steps up, and we had to deal with some kind of market turbulence and can change things that day. That's not the same thing with getting consumers a little more breathing room so they can get out spending and balance things out. So I am concerned that as any momentum were to build in deteriorating or weakening labor market, you just what the Fed can bring to the table would be very slow moving in terms of the interest rate relief. And I wouldn't expect fiscal to bring anything to the table to be helping if we were to go into a recession.
Claudia, given the lags, I'd love for you to talk about this. I think on Wall Street, we have a habit of making a big deal out of small margins. We talk about a big difference between, say, July and September. How big is the difference if the Fed chooses to move in September over, say, July?
I mean, there's what's the difference in the real world in terms of the economic output, in terms of what it does to inflation, which is what this is all supposed to be about, is getting inflation back down while keeping unemployment low, versus what it does in markets. I worry, and if nothing else, it would be good to have the Fed start really working in the market messaging so this is not disruptive, to move away from the idea that when we cut once, we're cutting 4 times, and somehow they have to navigate that all with the market at once. Just go once, and then we'll wait and we'll see. There's just something has gotten way too amped up about this in terms of the market space. The Fed's got to get that under control, because we're never going to have certainty about is this exactly the right time to do this. But they need to have tried to keep some better control over it, not get just ridden by the markets.
Claudia, always a pleasure to catch up with you. We'll leave it there, but we will come back to you because you know what happens on Friday. Everyone starts to cite you. We'll see what happens with unemployment, and we'll come back to you. Claudia Sahm there of New Century advises on the labour market and what the Fed should do. To Claudia's last point on the Federal Reserve, sort of get away from this idea that once we start, we have to keep on going. Is the ECB delivering a bit of a template for that right now, based on the last month?
It's trying to. We'll see, right? I mean, it's sort of the question of whether they're going to cut again in July. And basically, Christine Lagarde saying, don't expect it. Other people sort of saying, we have no idea. We're not committed. That was supposed to be the template. Key question, though, for the Federal Reserve is just whether or not they can, given their guidance, given their data dependency, move in that way, just because. And it sort of goes to Mohamed El-Erian's point of how constrained are they by being overly data dependent.
9:30 Eastern Time, you'll hear from both President Lagarde and Chairman Powell from Sintra, Portugal. Coming up next on this programme, Oppenheimer's John Stoltzfus, Brian Gardner of Stifel, Bloomberg's David Welch and Iain Stealey of JP Morgan Asset Management. The second hour of Bloomberg Surveillance up next.
I think we have to trade the earnings and the data that's coming at us.
There's room for downside surprise in earnings, but it may not be yet that we're starting that revision down cycle.
We probably have to pull in the expectations for the S&P 500 and then maybe be a bit more optimistic about some of the areas that have lagged.
Listen to the company's earnings call. Listen to them. They're all seeing weakness.
People look at the economy and say, that's fine, and then they double down on the bet on mega cap tech. None of these bets are going to get reversed until something shocks the system.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the second hour of Bloomberg Surveillance begins right now from New York for our audience worldwide. Good morning, good morning. Your equity market is negative by 0.4% on the S&P 500. In many ways, the jobs data begins today. Job openings coming up a little bit later. Then you'll get jobless claims tomorrow. Then on Friday, a payrolls report. It's a big day for you. We'll also hear from Chairman Powell at 9:30 Eastern Time. Alongside Lisa, the ECB President, Christine Lagarde.
Who's taken an ambiguous, I should say, approach as to the ECB's move this month. There's going to be a real question, though, for Chair Powell about whether he echoes what we heard from Austin Goolsbee, re-emphasizing this idea that if inflation is slowing materially, then where the Fed is currently is restrictive and increasingly so. And so that adjustment might be necessary. Are we going to hear the same thing from Fed Chair Jay Powell, indicating that maybe they are open to a sooner move on rates?
In the last 24 hours, these guys overshadowed by the politicians. Maybe even longer, the last couple of days. You include France in that, the last couple of weeks. Throw in the UK, it's been the last couple of years. We're all thinking about this. What would a Trump presidency mean for this market? And how different are things in 2024 versus, say, 2016? Mike Wilson of Morgan Stanley, I think, put it really, really well with this quote. The market welcomed a reflationary pro-fiscal playbook in 2016 as the economy was recovering from the manufacturing commodity downturn of 2015. And inflation was broadly not a headwind for consumers. This is a different backdrop from today. And I think that compare and contrast, 16 versus 2014, really important.
Cameron Dawson of New Edge Wealth had the same kind of tone yesterday when she came on the show. She was saying, basically, when you take a look at the unemployment rate, when you began that Trump presidency, it was 4.7%, wage growth growing somewhere in the mid-twos, completely different than where we are to now. Inflation's more of a consideration. And frankly, the tax cuts, if extended, are not going to provide the same sugar, as Cameron Dawson said, as maybe some of the, as it did back in 2016. These are the reasons why people are saying there aren't going to be the same kinds of economic boosts to offset potential headwinds created by tariffs, as well as some other more protectionist measures.
The Trump playbook of 16 was bond unfriendly, equity friendly. And basically the conversation we're having right now is, OK, again, bonds unfriendly. Will it be equity unfriendly as well? I go back to the performance of small caps in November 2016. We rallied that month by 11% on a Russell, on a small caps in America. Do you think that's the conversation this time around?
We're coming at a different level. Yields are already at a different level. Here is the ultimate question. At what point do bond yields affect stock valuations? We used to have this conversation before NVIDIA just took off and said, stop it already. That's a boring conversation. We have to reconsider that, though, especially if you keep seeing some of the other 493 names lag behind to such a degree, which is the reason why I want to understand this bond stock correlation a little bit better, outside maybe of big tech, which is a bit more noisy when it comes to this.
Well, let's get to the scores. This is what things look like right now. 2 trading days, Friday, Monday, a 17 basis point move on a 10-year yield. We pulled back just a touch. We're down a basis point on a 10-year this morning, 4.4494. In the FX market, the euro negative by 0.25%, 107.15. Mentioned Kit Jukes of SocGen in the last hour. Much more important for this pair, it's not rate differentials. It's not what the ECB or the Federal Reserve may or may not do. It is political differentials on either side of the Atlantic that could drive a stronger dollar and weigh on the euro.
But this is something you pointed out. any political disruption could only be had on the European side, because U.S. disruption evidently doesn't matter. If anything, it just sort of consolidates all the bets on the U.S. dollar, which just raises a question. Is there going to be any longer-term penalty? Is it just a dollar-positive, dollar-friendly bet, or is it also extended over into the treasuries? These are some of the questions that people don't really have answers to, despite some of the curve steepening that we've seen recently.
Euro-dollar 107.17. Coming up this hour, we'll catch up with Oppenheimer's John Stoltzfus as traders await fresh labour market data. We'll speak to Stifel's Gardner on the stock winners and losers of a Trump presidency, and JP Morgan's Iain Stealey ahead of Chairman Powell's remarks a little bit later this morning. We'll begin with our top story. Stocks looking for a fresh catalyst as traders weigh election risk and look ahead to key data. Oppenheimer's John Stoltzfus writing this: it is not uncommon in early bull markets for one or just a few sectors to gain traction and lead market performance before a broadening in performance takes hold. John's with us around the table. John, good morning to you.
Good morning, John.
John, it's amazing. We're talking to people about the labour market. They're flagging cracks, the prospect of an economic downturn, and you're talking about being constructive on consumer discretionary. Reconcile those two things for us.
Well, I think that my viewpoint in looking at the economic data really shows a recognition of the fact that we've had 11 rate hikes by the Federal Reserve and now not eight pauses since March of 2022. It's natural that the economy will be slowing. We've been pumped up for quite a while, whether it was fiscal policy, whether it was the stock market, the economy in general. But I don't think we're headed into a recession. I think the Fed is going to manage to avoid a recession this round. And as a result of that, I think the market really cares about mostly about revenue and earnings growth. And I think that we've consistently seen to be remarkably resilient. And the consumer is resilient in the stateside. It's slowed, but it's buying discounted things. I mean, when I go to the store now, I'm buying private label.
So how do you want to play the consumer, given your personal habits and given what you're seeing across the economy?
I'd say related to the consumer, I can't mention, as you know, any specific stocks, but I like outfits that will discount brands. I'm always looking for sales.
Companies that look like TJ Maxx?
Yep. Yeah, there you go. Very much so. And in fact, I have to say we do own some in portfolios that I manage. But neither an endorsement to buy or sell.
Of course, understood.
Okay, but my point is in the U.S. we really describe ourselves, we justify ourselves by the availability of shopping and being able to shop, whether it's online, and we like competition, we love sales. And I think that persists. Having done this this is 41 years into this. It's always a bad thing to bet against the consumer. Now, the sector isn't performing well this year on a year-to-date basis, but that doesn't mean it couldn't shine from here to the end of the year, as people recognize the fact that we'll muddle along through into the end of the year and likely see a pickup next year, irregardless of who wins the election.
Spending is slowing down. Citigroup put out their card spending, and you did see that pretty consistently across the board. There is a feeling that, as we just heard from Claudia Sahm, the labor market is slowing down, and there seems to be sort of this tipping point where, at least in her view, the Fed needs to start cutting rates to get ahead of more protracted weakening. Is that important for you as well, for your stock call?
I think it's not as important as it is to some. When I look at it, I think the Fed is certainly cognizant of the fact that it is nearing the end of this rate hike cycle. In what the chair has said every time we come out of an FOMC meeting, it's obvious that they're planning to cut. They are reluctant to cut because they know how insidious inflation can be in terms of the flame up of inflation. What we haven't seen yet, and what I'm looking for, is really increased competition in the sectors, and that's competition is the enemy of inflation. And you do get to see that in periods where you're coming out of an inflationary cycle. Initially, those who've been, the inputs were infected by higher inputs are reluctant to pass it on to their customers. Then once the press and the Fed have recognized there's inflation, people just bite the bullet and spend more. of their money to buy the same things, and then the resistance starts, and all of a sudden you'll find within sectors, you'll find competition reemerges, where somebody figures out what they give up on unit pricing, they can gain in volume. And it just happens. And today with AI, with just where it is today, advanced logistics, all of this it's already begun. If you look at the names, well, this with the names.
Just say what they rhyme with.
Yeah. Pardon?
Say what they rhyme with, the names that you're talking about.
Yeah, it's what you have to, within consumer discretionary, it's those outfits that send you the big boxes that you get every day. They buy in bulk, they
Okay.
they are competitively priced, and people shop.
So the Walmarts of the world, the Amazons of the world, et cetera,
exactly,
they're basically, they're cutting prices and they're kind of driving some of this competition. So are you saying that this sort of gives you confidence that growth is sort of more of a threat right now than inflation? Sort of this question around whether or not it's a good time to take risk because growth is being threatened. How do you sort of play that sort of uneasy balance that certainly the Fed is grappling with, as well as the ECB?
Well, I would say one thing that's important to remember is that I'm an intermediate to longer term investor, so I'm not trading in and out on a daily basis, though I frequently can tweak a portfolio depending upon the individual or idiosyncratic situation of names within a portfolio. But if the trend that's occurring right now seems very clear. It's about technology. It's about the industrial infrastructure rebuild, all the way from chips to plants and equipment, training people not only here but around the world. It's about healthcare. It's about energy. It's about the financial sector as we get more normalized in terms of a yield curve. You know, when I see rates, when I see the 10-year Treasury at 4.45, that looks pretty good to me. I can remember when the Federal Reserve had it as its inflation target 4%, and we just said, boy, oh boy, if we could get back to 4, you know, 4% inflation, we'd sign up for life. It's like, you know, give me an 8% mortgage, sign up for life. It's in different times. It's just we're coming out of a period of free money.
Yeah.
And people are spoiled. And I don't mean that it's not a let them eat cake moment.
Well, I appreciate that clarity, that correction. Let's talk about where the 10 years here over the last couple of days. How idiosyncratic was Thursday night?
You know, not as much as I think that people would really think. I think, if anything, and I say this completely politically agnostic, I think President Biden's performance was very well telegraphed by his performance since he took office, and he's been deteriorating in his ability to perform in terms of as in an act. You know, when politicians have to, it's like getting on stage, and he fumbled badly. But I don't think people who act like it was surprising, I think we're in denial, you know, and that's just the way it is.
Do you think the bond market responded to it?
You know, I think the bond market is trying to really looking to get attention from the Federal Reserve and saying, you know, give us.
Hold on a minute. The Treasury market's attention seeking.
Yeah.
Is that what you think?
I think. Listen, the bond market is. If you know bond traders, my guys, they're
always looking for attention.
They're always looking for attention.
This feels personal.
You know, this is. Let me tell you, when I go onto the trading floor, there's always a very different vibe from the fixed income area to the equity area.
They think they're smarter.
And it's a lot of it has to do. It's not only the skills of trading and finding the opportunities, especially today where people trade for bips. You know, it's not. It's everything is. It's the spreads can be very narrow instead of wide. It's an environment where, you know, it's a combination of skill, ego, and people talk their book. You know, you get like, I'm a bull, and of course I'm going to talk my book, but I base my book on fundamentals, and things just look. When I walk around the city, things are getting better. And it has very little to do with politicians. It's the business and the consumer are doing what they should be doing. They're showing up.
Good luck when you get back to work today. And you walk past the bond desk like that. John, it's good to see you. John Stoltzfus of Oppenheimer with the perfect description of dynamics on a trading floor in New York City. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. According to Bloomberg data, China's best-selling car brand BYD sold a record number of electric and hybrid vehicles in the second quarter. Price cuts and new tech helped the company sell nearly 1 million models. At 426,000 units, it's in striking distance of overtaking Tesla as the biggest seller of EVs globally. Tesla is expected to report second quarter deliveries this morning. The estimate is 439,000, alongside a slump in key markets like China and Europe. Now, a GameStop shareholder dropped a lawsuit against popular stock investor Keith Gill, a.k.a. Roaring Kitty. Martin Radev accused Gill of seeking to manipulate the stock for his own gain in a proposed class action suit filed on Friday. But late afternoon on Monday, Radev said that he was voluntarily dismissing the lawsuit. His lawyers didn't immediately respond to requests for comments, but the dismissal was without prejudice, meaning he is free to file the suit again. And the reigning NBA champion Boston Celtics are going on the market. Wick Grousbeck, whose family leads the ownership group, decided to sell the franchise for estate and family planning considerations, according to a statement. One of the other owners, Bain Caps Steve Pagliuca, wrote on X that he still hopes to be part of the Celtics moving forward. Boston won its 18th title last month, the most in league history. Sportico values the Celtics at $5.1 billion. That's the fourth highest in the league. It was purchased for $360 million in 2002. And that's your brief, John.
What a buy. What a buy. Danny, thank you. What a valuation increase as well. You know, a lot of people asked the same question yesterday. Mark Cuban, Mavericks, peak franchise valuations here?
That was exactly what I was thinking. How much is this basically exiting at the top and then going into, more European football games and football teams that he would like to buy?
Let's talk with Steve sometime soon. Steve, I'm sure you're watching, so we'll catch up soon. Up next on the program, President Biden's uphill battle.
I've said to you before, I'll say it again. It's not going to ever be a case about whether Biden makes the grade one time. He's going to have to make the grade every time between now and the election.
And he's got a little more than 4 months. That conversation next from New York City this morning. Good morning. The S&P 500 a little bit softer. We're negative. We're down here on the S&P by almost 0.5%, pulling back from yesterday's gains as we kick off the third quarter and the second half of 2024. In the bond market, Treasuries rallying, going against the grain of the last couple of trading days. We're down a single basis point on the 10-year at 444.94. Under surveillance this morning, President Biden's uphill battle.
You're going to have a Biden rescue effort going on over the next 7 to 10 days to try to mitigate that. And they also think, they've got 4 months to turn this around. I've said to you before, I'll say it again. It's not going to ever be a case about whether Biden makes the grade one time. He's going to have to make the grade every time between now and the election in order to put himself in the best position to win. Now he's starting off a little bit behind.
Here's the latest. Democrats weighing moving up the formal nomination process for President Biden to as soon as this month. The DNC aiming to secure the president's place on November ballots and curb any speculation that he could be replaced by another candidate. Brian Gardner of Stifel saying markets should favor another Trump term, writing that banks and consumer finance win with Trump and lose with Biden, going on to say that big tech loses either way. Brian joins us now for more. Brian, we'll get into the trades in just a moment. I want to talk about Thursday night and whether that really moved the dial for you or whether a lot of this was baked as far as you're concerned based on what you've seen over the last few months.
So, I went into the debate thinking that Donald Trump had a slight advantage over Joe Biden and that increased after Thursday night. And I think based on conversations that I had with investors, with clients, there was definitely a move within the market among the investment community that viewed it similarly, that Trump is in a better spot today. Biden clearly is weaker than pre-debate. So, yeah, it moved the needle a little bit.
Brian, let's run with that and talk about regulation and compare and contrast where we are now with this party compared to where we were in 2016. The Paul Ryans, the low taxes, those guys, those leaders, they're gone.
Gone.
If I look at the party right now, I'm not sure how pro-business we actually are in the Republican Party, because there are differences, as there always are, across parties. Have you got a clear read on that?
No, I think this has been an evolution in the Republican Party going on for several years. It is becoming more working class, more populist. As you noted, the Paul Ryans of the world are gone. Let me give you another stat, Jonathan, as we go into the tax debate of 2025, 2026. More than half of the House Republicans will have turned over since the 27 tax bill was passed. There's only going to be a handful of Republicans on the House Ways and Means Committee that were there for that last tax debate. And the replacements are more populist. You know, you look at a Marco Rubio from Florida, who in 2016, when he ran as a traditional Reagan Republican. He has clearly moved in the populist direction. J.D. Vance, another senator on the short list, could be Trump's running mate, really represents the ascendant populist wing of the Republican Party. That's not to say the entire party is controlled by the populists, but they are clearly ascendant.
Brian, to that point, why do you say tech loses either way?
Tech is just tech is not loved. Big tech, especially, is not loved in either party. And the criticisms from the two parties are different. From Republicans, it's interfering in free speech. For Democrats, it's not enough content moderation. Then you get into the whole antitrust argument, and there's a lot more commonality on antitrust. That big tech is too big, it is too controlling, there's too much consolidation of power among too few players. And I'll go back to J.D. Vance, since I mentioned him a moment ago. He says that Lyngen Khan, the head of the FTC during the Biden administration, is one of Biden's best nominees and should be reappointed if there were to be a second term. So it just gives you the sense that, tech being a focus of the current administration, it gives you a sense that that members of both parties do not like tech a whole lot.
It also raises this issue of how different would a Trump administration be from a Biden administration, and how much is this really coming down to whether there's a sweep on one side or another. Brian, what do you tell your clients who say, is there a better chance of a Republican sweep after Thursday? And what is the implication of that when it comes to spending, when it comes to deficits?
So, yes, I do think there is a better chance for a sweep. I think one of the fallouts from Thursday night could be to dampen Democratic turnout. And so while, there could be a level of ticket splitting between the presidential and the down ballot races, if Democrats are dispirited and fewer of them, especially younger voters in key states, don't show up in the numbers that Democrats need them to, it raises the prospect of a Republican sweep. What does that mean going forward? Well, on spending, it's tougher. I mean, Republicans have been talking about spending over the last couple of years in this administration. Traditionally, Republicans will highlight spending and deficits when they're out of power, kind of look the other way when they're in power. The truth of the matter is that the federal budget math is getting such that you cannot look away from it when you're in power. So that is going to become a bigger fight within the Republican Party if there's united government. And on taxes, this goes back to the populist argument. Corporations are not beloved among a lot of Republicans, especially populist House Republicans. And so in this tax debate that's coming up, I think two of the things you could see is, one, the top rate resetting and keeping the lower brackets at the current lower tax rate levels, and then bringing in the corporate rate and ticking it up a couple of percentage points to help keep the cost of extending those Trump tax cuts as low as possible.
Brian, got to squeeze this in. It's Tuesday, July 2nd. Tuesday, November 5th is about 4 months away. Does the Biden candidacy make it?
I think he will be the nominee, but I think time is running out very quickly for him to change voters' perceptions. One of the things we've seen in the polls, Jonathan, is that they are remarkably stable going back to the fall of 2023. Why is that? Because you have two candidates that are so well known by voters across the country. We can say it's early, but the fact of the matter is this is Donald Trump's third straight presidential campaign, Joe Biden's fourth time on the national ticket in the last 6 elections. that begs the question, what do voters not know about these, and how likely is it that they are going to change their minds in the coming months? And I think this is a different election because of that. I think we could know the answer of the outcome sooner than typical.
Interesting. Brian, well said. It's good to hear from you. Brian Gardner there of Stifel. On this race, 4 months left.
Yeah, although if the bond market's paying attention to the deficit, like the public officials, are they just looking for attention? Is that what we just heard?
I love the John Stoltzfus take. Just attention-seeking bond traders.
Think they know everything. Just want the Fed to pay attention. Give me love.
It's an interesting narrative. From New York City, this is Bloomberg. 2 hours away from the opening bell, equities pulling back on the S&P 500 by 0.5%. Decent day yesterday for the Nasdaq. We take some of that back. We're down 0.6%. Lots of questions about the small caps. If you believe Trump Playbook 2016 works in 2024, we should be doing quite nicely on a small cap, shouldn't we?
Maybe, if you get the tax cuts, if you get a deregulation, if you have some of the smaller banks benefiting from that. But as a lot of people have pointed out, you're starting at a very different place than you were in 2016 in terms of the unemployment rate, in terms of inflation, which is higher, in terms of just how much of the tax cuts have already been implemented. So how much more sugar is left, as Cameron Dawson said.
The size of the deficit, the overall debt pile, yeah, it's a very, very different economic backdrop. Very different backdrop in the bond market, full stop, period. The yen, 2016 versus 2024. This is where we are now. 2-year, 475.57. Yields coming back just a little bit on a 10-year at 445. Bear in mind, the previous 2 days we have pushed higher by something like 16, 17 basis points, Lisa, in just 2 trading days.
Yeah, and the biggest curve widening, the biggest increase of 10-year yields versus 2-year yields going back to early January as people try to suss out what some sort of sweep would be. Let's go with John Stoltzfus' discussion.
Attention-seeking?
They are attention-seeking. They're wondering when the Fed will wake up and see them. They're wondering when politicians will wake up and see them. If they really want to get attention, try harder, because this isn't going to do it. And that ultimately is what a lot of people are saying. As much as people cry and moan, you still have the Steve Eismans of the world saying, stop screaming away the deficit. I've been hearing this for 4 decades, and it never has changed. What is going to make a perpetual wake-up call will ultimately have to do with foreign investors pulling back and, frankly, a real ultimate question about if there's a better place to put your money, or real questions around the response function of fiscal in response to true economic weakness.
Steepener was a consensus trade for 2024, but bear steepener wasn't. So a lot of people just thought we'd get the steepener, but it would be driven by a rate cutting cycle that would drive a rally into the front end. The bear steepener just wasn't on the radar, really, for anybody.
Especially at a time when people are saying that the inflation risk isn't that significant. People are saying that's not the big risk. It's a growth concern. That all goes to the bull steepening. But the issue is people are really, truly thinking, OK, if you have an increase in deficits and you have an increase in tariffs and you have fewer immigrants, then you're looking at a very different scenario that potentially could pose a bit more of a challenge.
Reignite inflation risk. And Adam Posen of the Peterson Institute, I think, really started the conversation about 2 months ago, sat around this table and said, hold on a minute, look at what's here. Look at what's in this package, what could be delivered. In 2025, we might be talking about rate hikes again.
Part of the problem is that when anyone talks about this, and you heard this with John, this isn't political. People trying to distinguish the idea of talking about this objectively at a time where there is so much, I guess, subjectivity injected into this. And anytime you mention either of the presidential candidates, you're accused of one side or the other, or over-obsessing over this. The bottom line is there are real implications. The question is just what's going to get through. And if you take the former President Trump at his word, there could be a pretty inflationary policy.
I always go back to a phrase that Mark Dow used out on Twitter 8 years ago, when he said that the biggest challenge for an investor in this political backdrop was to divorce your political bias from your market call. Because so many people thought the Trump candidacy would be bad for markets. It was good for markets. Markets were good. They were decent. It was the policy backdrop. And I'm with you. You have to divorce your politics. Whatever you feel about either political party, either candidate, either individual, it's about the policies. And it's not just about the policies in isolation. It's about the policies against the backdrop that we're in right now. And I'll go back to what we talked about a little bit earlier this morning. In 2016, this bond market was crying, begging, demanding for there to be some kind of pickup in the fiscal impulse. In fact, Fed chair after Fed chair was going in front of Congress, practically asking them to do it. That's where we were in 2016. That's not where we are in 2024.
That's the reason why I think one of the most important things is going to be to see who Donald Trump nominates as his vice president. Is it going to be a J.D. Vance or is it going to be a Glenn Youngkin? That could give you a sense of what the actual policies will be and whether it's going to be business friendly or whether it's going to be much more in the populist vein, more akin, frankly, to some of the Democratic points of view.
Not as clear this time around. Not that it was clear last time around, given how some people positioned for it. Let's turn to foreign exchange. We need to talk about the euro and the Japanese yen. So Christine Lagarde's kicking off the get-together in Sintra, Portugal. ECB forum, a little bit like Jackson Hole, but with an ECB twist. So she's opened that up. She's talked down rate cuts in July of 2024, hardly parking them for the rest of the year, but I think maybe offering a template for what we could see from the Federal Reserve. That once they start, it doesn't mean that they go meeting after meeting after meeting after meeting.
Which is something that we've been hearing from a lot of people, a shallower rate cutting cycle. Just on your point about Sintra being like Jackson Hole, I feel like this is actually a cultural difference. The Jackson Hole, you go hiking, you stay in this sort of rustic lodge, and Sintra is this gorgeous, luxurious sort of place in Portugal, in a vacation spot, overlooking seas and having beautiful food. It's just a very different kind of scenario.
Yeah, the date's important too, because in Europe, after this, you take the rest of the summer off, and then for some reason, the Federal Reserve does its get together in August.
Yeah, right before you kick off the year.
Right.
It makes a lot more sense when it comes to business, but not living. It's more living to work rather than working to live. It's sort of the classic differential.
The clash of the European and American cultures. I know. All right. Under surveillance this morning, President Biden looking to shift the narrative away from his age and towards Donald Trump's behaviour, calling on voters to render a judgment on his opponent in response to the Supreme Court's ruling that Trump has some immunity from criminal charges. Try as he may, you can't get away from what happened on Thursday night, and they're going to struggle to.
And that's ultimately what we're seeing currently. You could make all sorts of discussions about the Supreme Court and some of the 6-3 rulings that have come out that have been fundamental. I think that Chevron case actually is more interesting from a business perspective. That said, the issue is people have already known all of this. And the Supreme Court isn't changing the narrative. Joe Biden isn't changing the narrative. It will take something a little bit more substantial.
I had one suggestion. If he wants to put to bed, if the campaign really wants to make out that Thursday night was just an anomaly, do a press conference. I heard that suggested yesterday. Do a press conference, a couple of hours, take questions from reporters repeatedly, and just show that that was a one-off on Thursday night.
Do a full court, don't protect.
Easy.
Put them out there, stop trying to shield. And that would be the one thing that could potentially shift the narrative.
It's not what we've seen over the last couple of days at all. Our next story is this one right here in New York. Manhattan home sales unexpectedly rising for the first time in 2 years. Data suggesting buyers may be viewing this period as a good time to make a move before the Fed starts easing. Things are picking up. We're greasing the wheels, so to speak, in Manhattan.
So I was looking at this article and I was thinking to myself, I wonder why. And how much is because people are expecting rates to go down? They could just refinance, right? I mean, basically, they're having a put on where valuations are, which have had something of a ceiling as a result of where yields are, where mortgage rates are. And if you think about it, if the Fed's going to cut by 50 basis points or even 100 basis points, they can refinance and get a lower premium.
Okay,
they pay every
implicit in that, though, is this underlying assumption that prices go up when they cut. Do you think prices go up or prices go down?
You know, I've heard arguments on both sides. And frankly, I don't have more clarity on it. There's this argument that if you have more supply coming into the market because more people are moving around, and that would happen after mortgage rates went down, that you could see prices go down. And then other people say this pent-up demand is so great, and the lack of housing is such that there would be resilience. I have a sneaking suspicion it depends on which area you're talking about. I have a sneaking suspicion that the Sun Belt, you're already starting to see some house price declines. Some of the areas that got bid up most after the pandemic might look a little bit different than some areas, particularly in the Northeast, that didn't get bid up quite as much.
Could be very, very regional. Let's turn to Tesla. Analysts expecting Tesla to report another quarter of weaker sales. The predicted 5.8% drop from a year ago would mark a second consecutive quarterly decline as the company struggles to continue its market dominance. Bloomberg's David Welch joins us now from Detroit for more. David, let's talk about the numbers. What are we looking for compared to where we were, say, last quarter? And what does the trend look like over the last year?
So we're looking for a nearly 6% decline from Tesla, and that's probably pretty reasonable because their China deliveries were down 24%. That's a very big number. And so you have two quarterly declines here, and the rest of the year it doesn't look a heck of a lot better because the product is kind of stale. There's a lot more competition. Tesla had a near monopoly on EVs in the U.S. market and a lot easier competition in China and even Europe over the last 4 or 5 years when they had this fantastic growth that everybody is still looking for to somehow out of Providence revive itself, and it's not. There's just too much competition now. You have General Motors, you have the Europeans gaining traction with their new EVs. Even Honda's got a couple out now. Even if they only sell them in small numbers, they're taking market share. On top of that, you've got consumers kind of scratching their heads over whether it's time to go electric. That's not helping them. And I think this is subjective, but I think Tesla has a styling problem at this point, and that is the cars all look alike. They all have that same look that debuted with the Model S in 2012. It hasn't really freshened up with the exception of the Cybertruck, which is not selling in big numbers at all. So you throw all that together, there's just not a lot that's really going to energize sales for them unless they really do, as Elon Musk has hinted at, come up with some really fresh product in 2025 and 2026.
Whatever these numbers look like, David, you know that for the bulls on Tesla stock, they'll just say August 8th, it's on the calendar, it's a big one. The robo-taxi's coming, that's going to change the game. How do you think about that?
Look, that's going to be really hard. You look at what the problems that General Motors has had with Cruise, and okay, if you want to say that's a one-off, that's one company doing robo-taxi that didn't work, but for Tesla it will. Waymo, which is Alphabet Inc.'s self-driving car company, they've been at this for more than a decade, and they're still only launching these vehicles in select markets in small numbers. The robo-taxi business itself is not generating huge revenue and great margins for them yet, and they've got some very good people working on this, again, for a long time. So how is Tesla going to come storming out of the gate with a robo-taxi business that's suddenly going to change revenue and earnings for them? Look, it's a lot of people have lost money betting against Elon, but it is just until we know exactly what they're announcing, it's tough to see this thing quickly turning around the perception of the stock and the actual revenue and margins for this company. So now. Could it generate enough hype because it looks really good in terms of the business plan for it, that it gets investors excited again? I think that's what they are relying on, and Elon's very good at keeping the narrative going and keeping people interested. So we'll see. I just don't see the robotaxi business itself generating huge numbers in the first year or maybe even couple of years. It's just a very difficult technology to perfect and a very difficult business model to execute.
David, we spent a disproportionate amount of time talking about Tesla, in part because we can't decide whether or not it's a tech company or a car company. I'm actually more curious about the car company side of it, and frankly, the other auto manufacturers that are going to be reporting some of their sales figures coming out today and throughout the month. Ultimately, there is a huge macro problem facing them, and you're starting to see sales slow more generally, just simply because the average auto loan has a rate of 10%. People cannot afford buying a new car in the same kind of way on credit that they did, say, 3 years ago. How much are you expecting this to sort of turbocharge the declines that we may see today and the rest of the week?
I'm not sure we'll see a big decline in vehicle sales. I mean, I think it could be down because a big chunk of U.S. dealers have been basically doing vehicle sales by paper because of this CDK cyber attack, and because, look, your bigger point is pricing of vehicles and interest rates. The overall affordability calculation is pretty rough on most consumers right now, and that's what's sort of leveled things off. I don't think it's going to be a terrible quarter, but it's not going to be a great one either, and we're still looking at sales numbers that are a bit below where they've traditionally been, which is more than 16 million units every year. Vehicles are still pretty expensive. Car companies are still kind of playing this game where they're avoiding discounting. They're keeping prices high because it's better for profitability, but consumers are squawking and saying, hey, no more. I'll just keep driving my vehicle for another year or two, and the repairs aren't as expensive as the monthly payments at today's interest rates, so I'll stick with that. And it's sort of like college tuition. It's at some point consumers say, I'm not going to pay it anymore because it's too much, and that means car makers are going to have to start discounting if they want to keep the volumes up. And you're seeing a bit of that. Hyundai and Kia are doing it. You've seen a bit of it from Stellantis. Ford and General Motors, I think, have held pricing, but we'll see how the numbers come in. But I think if they want to keep volume going, they're going to have to get prices. They're going to have to bring prices down, and not to crazy discounting levels, just something that's closer to pre-pandemic levels. You're still seeing people buy vehicles at well above pre-pandemic prices right now.
It's a tough market. It's super, super competitive. David, thank you, sir. David Welch there of Bloomberg, looking ahead to those Tesla delivery numbers. A little bit later, in about 30 minutes from now, we'll catch up with Ben Kallo of Baird. Looking forward to that conversation. 2 negative quarters of growth, and we're talking about a growth company here with a lofty multiple. That'll be the conversation in about 30 minutes' time. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, we can cross over to Danny Berger. Hey, Danny.
Hey, John. President Joe Biden's campaign says it raised $127 million in June. That is the best fundraising month for the campaign of this election cycle. It also includes $38 million that was raised in the 4 days starting Thursday, which was the day of the presidential debate. Biden aides have pointed to that ability to rake in cash despite his performance as evidence that the president retained his party's support and has not irrevocably damaged his campaign. Former Microsoft CEO Steve Ballmer has passed company co-founder Bill Gates on Monday to become the 6th richest person in the world for the first time. More than 90% of Ballmer's $156.7 billion fortune is in Microsoft shares. Gates, for his part, has diversified his wealth and slowly has been reducing his fortune through philanthropy, building the $75 billion Gates Foundation. Hurricane Beryl is now the earliest ever Category 5 storm in the Atlantic. Beryl, with maximum sustained winds of 165 miles per hour, is headed towards Jamaica. Typically, the first hurricane arrives in the Atlantic by August 11th, according to the Hurricane Center. With 3 storms already in the books, the season is running ahead of pace. Early forecasts called for this to be an active year. And that's your brief, John.
That's what it looks like. Brutal. Danny, thank you. More from Danny in about 30 minutes' time. Up next on this programme, election risks move the market.
I do think that what happened on Thursday meaningfully increases the likelihood of a Republican sweep in November. Tariffs are a elixir for stagflation. Tariffs slow growth and push up inflation at the same time.
That conversation up next from New York. You're watching Bloomberg Surveillance. Let's show you some of the scores. The price action looks like this on the S&P 500. We're negative by, let's call it 0.5% on the S&P. The bond market is where all the noise has been over the last couple of days, particularly at the long end of the curve. Very quiet at the front. Yields lower by a single basis point, 445.34 on the US 10-year. Under surveillance this morning, election risk moving the market.
As an investor, perhaps it's a bit early, but you can't really ignore what happened on Thursday. Renewal of tax cuts and tariffs, all of those things end up being somewhat inflationary.
I think that the risk is that yields do move higher, because the other thing we heard from the debate is that neither party is considering austerity.
One of the more controversial policies that the Trump administration is talking about is inflationary.
Now, tariffs are a elixir for stagflation.
It's the talk of Wall Street over the last couple of days. Here's the latest. Bond traders weighing the potential economic implications of a Trump victory in November. A growing chorus of Wall Street urging clients to position for sticky inflation and higher long-term bond yields. Iain Stealey of JP Morgan Asset Management joins us now for more. Iain, this has been a question we've been leaning on over the last 24 hours, all the way back to Friday. What does Thursday night change for this bond market?
I think Thursday night brings into perspective for the market that the election is coming up. So I think the market only likes to focus on a couple of things at once, and maybe it had parked the election for the time being, was looking at what was going on in Europe and possibly some slowing from the US economy standpoint. But now, obviously, Thursday brought the election front of mind again, and what could happen, as we just heard from those clips, around tariffs, around taxes, and ultimately, would that keep inflation sticky, or would it even elevate inflation further? And then what does that mean for the long end of the bond market? And that's really what the market's been digesting over the last 48 hours of trading or so.
Iain, let's talk about the shape of this bond market and how things have evolved over the last couple of days. So coming into this year, we had the curve deeply inverted. It's still inverted, 2-year out to 10-year, right across through the curve. And a lot of people were looking for the steepener, but they thought it would be driven by a rate-cutting cycle that would fuel a rally at the front end of the curve. That's not been happening. Iain, what's happening is this so-called bear steepener, which you know is driven by a sell-off in the longer end of the curve, yields pushing higher. How sustainable do you think this evolution is?
I think you've got two components of it. So the front end remains reasonably well anchored, because we've heard categorically from the Federal Reserve they do not want to hike rates further from here, and they do believe the next move will be a cut. So that does keep two-year yields pinned to some extent, and we've seen that over the last couple of trading sessions. And then it's the long end, which can really move around. It can wax and wane with what the market's expectations are for demand and ultimately supply. And it's that supply that's going to come to the market if we are expecting further deficit increases across the US. And it's really that's been concerning the market to some extent. And a lot of people, as you said, have been positioned for this steepening to occur, and the trouble they've had is that it's negative carry. There's a cost to owning the steepness. Having that steepening on hasn't worked, so a lot of people then moved out of that steepening risk, and then we've had this knee-jerk reaction over the last couple of days.
Just to put this very simply, Iain, is this a buying opportunity on the long end for you?
I would argue it's actually more of a buying opportunity in more of intermediate bonds, because I do believe the long end is going to, say, move around based on what we're hearing around the election risk, where it's that front end, it's the intermediate, the 5-year part of the curve that's going to be held down by what the Fed's up to. And that, I think, is going to be more, you get more confidence that those areas is where you're buying. So if you think about the convexity of a 2-year bond today, we're at 475. We're pricing, a couple of cuts in. Imagine they don't do that. Imagine they just do one. Well, maybe yields move a little bit higher from where we are today. But if things do go wrong, if you do get a sudden slowdown, if we get a bad payroll print on Friday, you could see those yields move remarkably lower. So I think your risk reward for owning the front end makes a lot of sense. I think it is more challenged in the back end.
There's this ultimate question, and John was asking this earlier, this question of why is the U.S. immune to political risk being a liability for the nation's currency, for the nation's bonds, just in a point-blank way, the way it is, for example, in France, the way we've seen kind of stay sticky. Is there going to be a point at which either there's going to be convergence with French bonds getting a rally, yields coming in more aggressively, or on the flip side, this type of move to be sustained simply because people are sick of it with the U.S., feeling like it can always just have the privilege of acting recklessly?
I do think the US gets a bit of a pass, given it's the reserve currency of the world, but I don't think they're completely immune to it. And I think that's what we've seen over the last couple of days, that ultimately when the considerations are that you are going to get a lot of supply to the market, that needs to be taken down. Someone ultimately needs to buy that. And if people want to buy it, maybe they need to be compensated a little bit more. So we're getting higher yields on the back of that.
75 basis point spread, something like that, Iain, between Germany and France. Lisa asked this question yesterday. I think it's worth repeating again. Do you think this wider spread between France and Germany is the new normal in Europe?
I do think it is a new normal. So I think what we've seen just since the results on over the weekend, it does feel that some of that tail risk of a left majority, or that tail risk of a left majority has been removed. We're going to find out over the next couple of days and over the weekend what actually happens in France. But I think fundamentally it does mean that France is more of a deteriorating story. So yes, you can see a little bit of a relief rally, and we saw a bit yesterday, and maybe after next weekend you'll see a little bit further. But that would, to me, be somewhere in the 60 to 70 range for that French-German spread. I don't see us going back to 40 or 50, which is where we were pre the election. I think there's just a perceived risk now in France that wasn't there earlier this year.
So, Iain, I'd have to say, would you see it going to 100, 150 then? And if you don't, is it a buy right now?
I think it is a buy. We've started to lean in a little bit. I do think there is the ability for spreads to go wider, but you would have to have, similar to what we've been talking about for the US, you'd have to have more concerns that there will be some loosening of the fiscal side. And I think the right wing, they are looking at the 2027 presidential elections. They want to be seen as credible for that. And then they're also looking backwards at what happened in the UK 2 years ago and not wanting a repeat of that. So I do think there will be some fiscal restraint. We've heard that from them. So I don't expect us to go to the 100 basis or 150 basis points level. That could be a concern. I think we consolidate around here. Ultimately, you do want to be owning it at these levels, but you're probably not going to get a huge amount of satisfaction if you're only going back to, say, the mid-60s. I think there's more opportunity in what I would call slightly better credits like Spain or places like Italy where there's more valuation.
Just real quickly, Iain, earlier this morning we had John Stoltzfus on, who said that a lot of the move that we've seen in treasuries has just been bond traders looking for attention, thinking they know everything, and just trying to maybe get some recognition from the government or from the Fed. Do you think that that's true characterization?
No, I think it's ultimately you go back to the fundamentals and you go back to the technicals, and you believe that if we are going to have a higher deficit, if we are going to have more supply to the market, bond investors want to be compensated, so they need higher yields for that to happen.
Iain, it's good to hear from you. Iain Stealey of JP Morgan, and what's happening in Europe and in the global bond market. It's amazing to keep hearing the same thing, that ultimately the strongest pillar of the bond bull case in Europe is that nobody wants to be Liz Truss. Isn't that amazing?
I mean, this is basically the argument that essentially the market's going to discipline a lot of populist governments.
Yeah.
And that essentially that was already tested and done and dusted. Unclear. I guess that's really the question. One story that I was watching overnight was this idea that the union on the left and in the center in France is kind of splintering, and you're seeing that in a more significant way. If that truly does splinter, do we start having a different conversation about just how much discipline this market can inject on any kind of populist policies?
And let's see where we are Monday morning in that French bond market. Coming up, in the third hour of Bloomberg Surveillance, we'll catch up with Matt Miskin of John Hancock. We'll speak to Ben Kallo of Baird on Tesla. Looking forward to that. Iain Lyngen of BMO calling it political provocation in the bond market. It's quite a phrase in the last 24 hours. Dean Maki of Point 72 joining us as well. Dean's going to break down what he's looking for in the labour market with jobs coming up just around the corner. Head of payrolls on Friday and jobless claims tomorrow from New York. All of that still to come.
We've been anticipating an inflection point in the economy, so you're going to see some flexibility in the data.
We're not at the point yet where things are falling off a cliff, but we're definitely coming off the boil.
If you factor in the Fed policy and how the Fed will have to react to inflationary environment, that could really push growth down.
As far as the Fed is concerned, we should take them at face value. The driver for them has to be really real-time data.
Once bitten, twice shy. Most likely, I think they're going to be a bit late and a bit behind the curve here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the third hour of Bloomberg Surveillance begins right now from New York. Looking ahead to two things. Looking ahead to jobs data at 10 a.m. Eastern Time. Job openings in America. Before we get there, 30 minutes before that, you will hear from Chairman Powell in Sintra, Portugal. Here's a preview. Not mine. This belongs to Citi. Dovish signs from Sintra. Andrew Hoddenhorst expecting the following. We expect Chairman Powell to strike a dovish tone as economic activity and prices have both slowed, according to recent data.
Well, he says this at a time where they're expecting the jobs print on Friday to be 155,000, down from the expected consensus of 200,000. But frankly, it comes after Austin Goolsbee really did signal a dovish tone, which is as per usual, since he does tend to have a more dovish tilt, talking about how, given how much inflation's coming down, they will be overly restrictive if they keep rates where they are. The whole idea of a mid-cycle adjustment really coming to the fore.
A great exchange with Francine Lacqua a little bit earlier. We've heard signs of this now for the best part of 12 months, that they don't want to be responsible for passive tightening. What's interesting to me is that it's gone quiet in the core of the committee over the last couple of months, because this would really speak to a mid-cycle adjustment. Just do a couple of moves, settle things down, and then look ahead, wait for the data, wait and see. Why isn't that the dominant conversation taking place on the FOMC going into July?
Because there are some signs of sticky inflation that continue, and whether it's in housing, which has continued to be a complete mystery, I would say, for a lot of people, whether it has to do with commodities, also showing kind of conflicting signs, or whether it shows to a stickiness in services spending, there is an uncertainty of just whether the inflation beast has truly been killed. There is an issue as you look forward about whether to focus on the ISM manufacturing that came out yesterday that we're not even talking about. It came in disappointing, but it also showed a disinflation under the hood when it comes to some of these goods. Or do we focus purely on services, and we do get the ISM services tomorrow, to see whether we do have that same disinflation trend there? That might be the key for the center of the committee.
3 straight months of contracting factory data. Just to return to the calendar again, later this morning at 10 a.m. Eastern Time, job openings. Tomorrow, the big one, because the market's closed on Thursday, you'll get ADP, you'll get initial jobless claims, you'll get an S&P Global PMI, you'll get factory orders, you'll get the ISM Services Index as well, Lisa. That's quite a 24 hours coming up on the data front.
A data dump ahead of the key one on Friday, where everyone's going to be at the beach, but they're going to have to dial back in so that they can trade around what gets out from the non-farm payrolls. To me, of all of those readings, potentially any kind of aberration could move the dial. To me, today's jolt up job openings might be the most important. If they come down to that pre-pandemic level, which is as expected, 7.9 million openings, people are saying that will move the dial, because all of a sudden we'll be talking about a normalized labor market that's inflecting downward, to Claudia Sahm's point.
Will we be talking about normal or something more sinister? Let's go back to the framing we've used on this programme over the last I think 3-4 months. The difference between a welcome cooling and an unwelcome deterioration. If we get downside surprises on jobs data, do you think this market is willing to see that through rose-tinted glasses anymore, to say that's a welcome cooling and not an unwelcome deterioration?
Which market? I would argue that probably the front end of the yield curve has already started to sniff out a little bit an unwelcome cooling, which is sort of speaking to the fact that you have a couple rate cuts being projected out. You mean the equity market? Some people would say that actually the other 493 stocks have already sniffed that out. The Russell 2000, very much smelling that kind of weakness.
Stocks negative again this morning. Some weakness for you this morning. We're negative by 0.5%. The scores look like this in the bond market after the two-day sell-off Friday, Monday, following the events of Thursday night. Stateside, yields are lower by 2 basis points, taking some of that sell-off back. Your 10 years at 4.44. In the FX market, talked a lot about Chairman Powell in Sintra, Portugal. The ECB President Christine Lagarde speaking just yesterday to open up that forum, pouring some extra freezing cold water over a July rate cut at the ECB. Euro 107.28. We're negative about 0.1%. Coming up this hour, we'll catch up with John Hancock's Matt Miskin as investors weigh second half risks. We'll speak to Baird's Ben Kallo as Tesla reports second quarter deliveries a little bit later today. And BMO's Iain Lyngen as Wall Street maps out how a Trump victory would impact the bond market. We begin with our top story. 90 minutes to go until Fed Chair Jay Powell speaks at the ECB forum. John Hancock's Matt Miskin saying this: the Fed is likely to be one of the few central banks that can't cut yet. All the cool kids have cut, but the Fed is being left behind. The last inflation report was good, but one report does not make a trend. Powell likely reiterates that they need further evidence to be confident that inflation is going to their 2% target. Matt Miskin is with us now for more. So, Matt, would you say, I'm not going to say they're ignoring some of the weaker labour market data, but it's not as important, the developments in CPI?
Initial jobless claims still at around 200,000 is fine. You know, if you look at initial jobless claims as your primary input, because that's going to be really the signal that's going to show you that the labor market is deteriorating. At 230,000, it's still not bad. When it gets to about 300,000, that's when the Fed is going to have to pivot hard and start to cut. But the inflation data just in the last month was great, and we all celebrated, right? But in Q1, it wasn't great. And we need more data points, in our view, for the Fed to be confident. Look, you're getting paid great yield in the United States bond market right now. Just be patient. The higher yields right now is a gift. I know we've been talking a lot this morning about it maybe being politically driven. But if inflation does come down over the course of the year and eventually the Fed does cut, this higher yields will be an opportunity. That's what we look at in this bond market today.
You went to the politics, so let's go there too. I'll add to it, using your words. There is a lack of geopolitical risk being priced into markets with an elevated PE on the S&P 500 at 21 times and high yield spreads at only 3%. Regardless of the election winner, either one will be taking an economy that has been benefiting from massive fiscal stimulus that is unsustainable at this pace. John, we've been asking this, Matt, we've been asking this repeatedly. Thursday evening, how does it change this bond market, not just for the next week, but for the next 12 months?
I just don't see it, John, in terms of what it does. I think you actually said it best, I think, earlier, where you said it's all about the context. Think about, under the Biden administration, the best performing sector has been the energy sector. And I'm not talking alternative energy. I'm talking drill, baby, drill, Texas energy companies. Now, how did that happen? It's because they were down a lot prior to the 2020 election. They were really cheap, and they did recover. It was the private sector. The private sector is going to be dominant here, and we're coming off of all this fiscal policy that's likely to decelerate regardless of who is in office. We think the bond market is getting a bit spooked, but we actually believe that over time, it's going to be inflation that drives it. If you don't have a major pandemic or shutting down the economy or therefore fiscal policy that is historic in nature, that trend probably continues. So we really think it's all about the context, and whoever's going to be in office into the next 4 years is likely going to be seeing a deceleration in inflation back to the old demographics driving the narrative and the backdrop of growth environment. And things are expensive right now in terms of equities. And so in our view, we would, again, look at this backup and bond yields as an opportunity. We would look at defensive parts of the market as an opportunity because there are some risks out there. But politically, we would divorce that from your investment decisions.
So a buying opportunity when it comes to 10-year yields in particular, is that what you're saying? Because we were just talking earlier with Iain Stealey, and he's saying, that's kind of a risk. Maybe just stay in the belly.
Yeah, I mean, we do like the 10-year. And right now, you think about the intermediate part of the curve, we are getting about 5% on the U.S. aggregate bond index. The highest in the last 20 years is just about 5.9. So, it is still near those highs of the last 20 years. If you could do 5 to 6%, even with a little bit of a credit bias over the next 5 to 7 years, we think that's going to be a really attractive risk-adjusted return. And right now, again, you're thinking about, trading this around all this economic data, the election. Just think about, high-quality bonds. If you get that over the next 5 to 7 years, that's really what bond investors should be focused on, not the day-to-day, not all the noise. Right now, you really need noise. You need headphones right now that are going to be really good at noise canceling. That's what investors should be focused on is just the income component. And on a global basis, I know, Lisa, you've been talking about this. On a global basis, U.S. yields are really attractive. They're the highest versus Chinese yields in history. They're a lot higher than European yields. They're a lot higher than Japanese yields. So you've got the best yields in the world. You got to be patient for that duration tailwind. But when it comes, you might get 5 years of bond returns in 12 months. And if you're out of it and you're not there, you're not able to get it.
Which raises questions about just how bearish you are on the U.S. economy, frankly, because it means that you think that that inflation is going to cool and that any new president is going to be dealt a pretty bad hand when it comes to fiscal stimulus coming off, inability to really stimulate more, and a lot of the right sizing, et cetera, already happening in a lot of companies. What does defensive mean in an equity market where some of the big tech names have been called defensive, growth, value, and everything else?
Yeah, so the quality factor and the momentum factor, frankly, have been just dominant in the U.S. equity market. And we still like the quality factor. I mean, you think about good balance sheets. You don't need cost. You don't need capital. Companies that don't make money right now need capital, and it's really expensive. We think that's going to continue for the end of the year. And then we think defensive equities like dividend payers, utility type companies. We think those actually get more love into the end of the year and into next year. They have been cheapened up. They've been unloved. And even in bonds, higher quality bonds have really lagged credit. They lagged equities. Those could actually make a comeback into the next year. So, there's a lot of defensive options. In terms of the economy, we do think it's okay, but it's hard to get a real gauge because it's been just so medicated with all this fiscal stimulus. And you take that off, the Fed's going to have to step up and be the next one to stimulate. And we think that's a 2025 story. So we want to position before that. And there's a lot of defensive options on sale in case of any confidence exogenous shock that does happen in the next 6 months.
Matt, I've got to ask you, do NVIDIA make noise-cancelling headphones?
That'll be the next thing. I know Apple with a robot or something like that and next noise-canceling headphones. But investors are going to need nerves of steel, John. And you guys are going to be in the forefront of it. It's going to be interesting either way, but for us, it's really about educating and making sure investors are focused on the things that drive markets like earnings, the economy, and focusing on risk management.
Appreciate the education. Thank you, sir. Matt Miskin there at John Hancock on this bond market. Equities too. Serious dimension to that question. When we're thinking about noise-cancelling headphones, they're made by the Treasury, they're made by NVIDIA. What are people really seeking out right now to sort of cancel out the noise?
They have been made by NVIDIA for the past 6 months, which is the reason why those shares are up something like 140%, because people are saying, ignore the political noise, ignore the macroeconomic noise, just take a look at the cash machine that is NVIDIA and say, yeah, that sounds good. Question now is just whether it's gotten so bid up, and I go back to that Torsten Slok statistic saying that basically the top 10 stocks account for more than 30% of the S&P 500 when you look at the market cap, but only 24% of the expected profits. That is the issue. At what point have people gotten over their skis with what they expect? From behemoths that are cash cows currently, how long can they continue to have those incredible billion-dollar beats?
NVIDIA down this morning by 1.2% in the pre-market. The broader equity market down as well. We're down about 0.4% on the S&P 500. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. After the Supreme Court ruling, Donald Trump is making a fresh push to have his New York hush money conviction overturned. The U.S. Supreme Court ruled yesterday yesterday that Trump has substantial immunity from criminal prosecution for actions taken while president. Bloomberg reports that Trump's lawyers are taking steps to request that the verdict of his New York trial be tossed out. The lawyers are also proposing delaying his July 11th sentencing. And more home buyers in Manhattan are taking the plunge instead of waiting for rates to come down. According to firms Miller Samuel and Douglas Elliman Real Estate, closings for co-ops and condos spiked 12.2% for the second quarter of this year compared to last year. The median price of $1.18 million is slightly down, but still near record highs. Deals closed with a mortgage were also up 15%, while deals closed with cash were up just 10.6%. And a GameStop shareholder has dropped a lawsuit against popular stock investor Keith Gill, a.k.a. Roaring Kitty. Martin Radev accused Gill of seeking to manipulate the stock for his own gain in a proposed class action lawsuit filed on Friday. But late afternoon on Monday, Radev said that he was voluntarily dismissing the lawsuit. His lawyers didn't immediately respond to requests for comment, but the dismissal is without prejudice, meaning he is free to file the suit again. And that's your Bloomberg Brief. John.
Danny, thank you. We'll touch base with Danny again in about 30 minutes. Up next on the programme, we'll get you some morning calls, plus Baird's Ben Kallo as investors await Tesla deliveries a little bit later on. That conversation coming up next from New York City this morning. Good morning. Let's check out the scores and go to the bond market first. I want to talk about treasuries just briefly. Treasury yields repricing higher over 2 days, Friday, Monday. Yields are a little bit lower today by 2 basis points at 443.75. What would change this story? Andrew Brenner and Nat Alliance. We need a dovish Powell, good jolts, and a good non-farm payroll to stop the steamroller ride of bonds towards higher yields and a steeper curve. We're not optimistic in the short end. The election cycle has now made its way into the bond market, and don't forget to keep the yen and oil on your front screen. This is important, the election and what it means for this bond market going forward.
Especially given the oil, and I'm glad that he brought this up, given the fact that there is this increase under the hood in crude. Look, this is really the big debate. When do people get conviction to go into long-term treasuries at a time where there is a lot of uncertainty politically, and it's not clear that the Fed could get ahead of that? Didn't we hear from Krishnamurti? The Fed is sort of de-emphasized right now, given that the political noise, those noise-canceling headphones just aren't working.
Could really feel it in the last couple of days. We're lower this morning on yield by 2 basis points, about 443. Equities near session lows were down about 0.4%. Let's get you some morning calls. First up, Guggenheim cutting its price target on McDonald's to 280. The analyst removing the chain's best idea designation, but noting long-term structural advantages. Next up, Stifel raising its price target on Costco to 900. The analyst highlighting the big box chains accelerating grocery share gains over the past 5 years. And finally, Baird maintaining its 280 price target and outperform rating on Tesla. Analyst Ben Kallo saying that while delivery numbers still matter, he sees attention shifting ahead to the August 8th robo-taxi unveiling. That stock is down this morning by 1.6%. And Ben joins us now. Ben, let's get to it. We'll separate those two stories. We'll start with deliveries and then we can talk about August 8th. What are you expecting today on the delivery side of things?
Hey, good morning. Thanks for having me on, as always. So we're expecting 435,000 deliveries. The streets are slightly above us. I think deliveries are expected to be weak. So if they get close to our numbers, I think the stock reacts very positively because everyone's looking ahead first to that robo-taxi event in August 8th, and really into next year with the next generation vehicle platform coming online.
You can tell that because it's in the price band, because if we were looking at a company that had 2 negative quarters of growth, we'd be wondering why it's a growth stock. But it still is, based on what people still expect over the next 12 months or so, Ben, particularly starting with August 8th. So let's go to it. How much of a game changer is August 8th? And when can we expect to actually see this rolled out and delivering top and bottom line growth?
Well, so I think we're going to separate a couple of different things. First, robo-taxi. I think that we look at it in 2 different ways. First, does Tesla own their own fleet? We think they do. So they'll put a small number of cars out there. And I think probably as early as next year, sometime next year, and then start rolling it out, the option out to its car owners to use a robo-taxi type application where they could use their cars and rent them out to other people. I think that's more of a longer term type of event. And then at the event, I also think that we probably can get a reveal on the next generation platform which should include multiple different vehicles. I don't know if they show them all at once, but this is something that the market is looking forward to. So like you said, we've been in a period of volume kind of stagnation, and the next generation platform really gets you back into that growth mode. And we should see that, going on into 26, as they've said that they've started ramping up production late this year and into next year.
So shares currently around $208 each. So you're seeing about a 35% upside. I'm just curious about how big the bar is for you, how high the bar is for you on August 8th to really justify that valuation, whether if they don't meet your expectations, you would actually become bearish in the name.
Well, I think that just overall, me included, and investors all over, have fatigue around Musk saying, full self-driving will be here in 1 year. They've been saying that for 5 years. Now, this is a very, very difficult problem to tackle. Many different companies are trying to tackle it. We think Tesla's in the lead on the front here. But I do think that, Musk has learned over the years about timelines. And I think putting this event in August 8th, there's a realistic chance that we see, cars on the road performing, the robotaxi application within the next 6 to 12 months. And I think that bar is high, but I think that they'll meet that bar.
I have to say, Ben, one aspect that people don't talk about when they say the robotaxi is just what's the kind of lag time to get some of the trials up and running for the regulators to sign off on it. I remember back in Texas when they were having some of the robocars being tested out. I know that GM has had some snafus with their taxis, the robotaxi type of service in San Francisco. How high is the bar just to get it up and running and profitable? And is that important to you?
It is important, and I think that they'll choose their location specifically where they can get cars out to the road the soonest. There's areas in Phoenix, for example, but different states have different rules around putting self-driving cars on the road. I do think that that's probably the lag time, where I say 6 months from August before they get cars on the road. It's more from a regulatory perspective than from a technology perspective. We haven't seen, and one key thing that we're looking towards is when Tesla starts taking liability of the full self-driving. Right now, they caveat everything. There's nags on the steering wheel where you have to hold the steering wheel. When they start removing that type of thing, that shows that they're taking some of that liability on. And I think that shows, that the technology has evolved to where it's really functional.
Ben, appreciate the update on your view. Looking forward to the numbers later. Ben Kallo there of Baird. I say we're looking forward to the numbers, but ultimately what we're hearing from a lot of bulls on the stock is that the numbers don't really matter. What matters is what happens on August 8th and what they're looking for in 2025. As
of right now, the numbers don't look very good. There have been a number of declines when it comes to their sales. Today, it's being reported that their sales in China fell 24% in the latest reporting period. This isn't small. I remember when we used to say that China mattered. It doesn't, evidently, because robotaxis. So at what point do you have to see something that can deliver profitability in order to, continue to feel bullish on this name?
Can I change the subject?
Yeah, please.
I know that you love this story and don't like that one so much. This is from Bernie Sanders, Senator Sanders, and the president. Yeah, sure. Okay. Op-ed piece published in USA Today. They want lower prices on Ozempic and Wegovy. This is the quote. If Novo Nordisk and other pharmaceutical companies refuse to substantially lower prescription drug prices in our country and end their greed, we will do everything within our power to end it for them. Talk about trying to change the subject from Thursday night.
Okay, I do love this story. First of all, Novo Nordisk shares did initially have a 3% drop. They have currently fallen to less than about 1%, so not exactly a massive move. It just is an interesting moment. This is President Biden and Senator Bernie Sanders in an op-ed in the USA Today newspaper in the United States. A question of whether basically saying, if you're on Ozempic and you're paying $1,000 a month, we're going to be there for you. We're going to cut your student loans. We're going to get you free houses. Yeah. It's sort of like, all right, I understand you're basically flooding the zone. At the same time, how much is going to ring true at a time where ultimately it is up to Medicare and Medicaid, and they've been really pushing back pretty dramatically as far as coverage goes. And, how much can you potentially do this, the legality of it? It's just talk about changing the subject.
Yeah, or attempting to. Attempting to, I think, is probably the right way of framing this, because they're not going to be able to change the subject from Thursday night. They can keep trying. They can keep trying, but they're not going to be able to.
What are you talking about? I'm just thinking about Ozempic.
Oh, is that all you're thinking about now?
Well, I'm being somewhat facetious, but this issue is that you just wonder how many things are they going to pull out to try to shift the topic, and at one point they have to actually address the elephant that's standing in the room on the table, just sort of saying, "Hello, here I am."
Yeah, it's not going away. You have to keep remembering why we did that debate at the end of June, because this campaign wanted it there. They wanted to get voters engaged ahead of November. They thought it was going to help them. It hasn't. It's hurt them.
I wonder if donors are going to push back, because so far it's kind of mixed. We're hearing mixed reports. I've been reading a lot about this. How much do donors say, all right, can we try to shift this a little bit?
Hard to know who to trust now. Honestly, I think that's the way a lot of people feel in this country.
And how they pass his war chest of money on to somebody other than Kamala Harris, which is a big problem as well for them.
Yeah, we're looking ahead to economic data, so we'll focus on that. We'll catch up with Dean Maki of Point 72 and BMO's Iain Lyngen up next. Let's get you set up for the next 60 minutes or so. So we have got Chairman Powell speaking in about an hour from now, 60 minutes away, around the opening bell. In New York City, Chairman Powell will be in Sintra, Portugal, delivering an address alongside President Lagarde at the ECB's forum. Looking ahead to all of that, your equity market right now is negative by about 0.4%. We're pulling back by 0.5% on the Nasdaq 100, just taking away some of yesterday's gains. In the bond market, taking back some of yesterday's sell-off. In Treasuries right now, yields just a little bit lower by 2 basis points, 4.4375. And Lisa, we've been asking the question, others too, what would stem this sell-off of the last couple of days?
And maybe it's just levels. I mean, we heard from Matt Miskin over at John Hancock that it's a buying opportunity just simply because it's high yields and you've got to ignore the noise. Question is, especially as it gets noisier and noisier, a lot of us don't have noise canceling headphones that can really select what you should be paying attention to or not. November looms large. Expect more of this, and we've heard that from a lot of people.
Yeah, you can't cancel it out, which is why the movement at the long end's been noisy, but the front end's been quiet. And I want to talk about that just briefly, why the front end has been so quiet, given these conversations that we're having.
Partly because the Fed basically said that they're not going to raise rates, period, full stop. The issue now is just how quickly the economy is weakening. Really interesting, and you've been raising this over at the ECB, where there's been sort of a similar trend. Are they going to be the leaders in terms of cutting rates once and then not cutting again? And what we heard from Philip Lane over at the ECB during the Sintra conference is essentially there is a fundamental question on services, and it's a global question. At what point do you see true disinflation in that area akin to what these central bankers need to see?
Based on what we've heard from the core of the ECB executive board, from the chief economist, from the ECB president, July ain't happening at the ECB, based on current communication. Let's check out the euro. It's weaker today by about 0.1%. I can tell you the dollar is stronger against everything in G10 with the exception of the British pound and the Canadian dollar. If you want to look at dollar yen, which has shown just a little bit of weakness too, we got close to 162 earlier, 161.56. Don't know how many times we have to say this. The verbal intervention is not working in Japan.
Vanguard is saying that it could get to 170, which would be a new record if post-1986 if the Bank of Japan does not raise rates at the July meeting, at this month's meeting. And this is really the key question. How will there be a response at a time where some people are saying that the authorities aren't that alarmed? I will say that they do get a lot of tourism. I don't know if people like that or not in Japan, but I've heard first from secondhand that it's actually a quite good time to visit.
I think the tourists like it, that's for sure.
Yeah.
Much weaker Japanese yen. Let's get you some top stories. Under surveillance this morning, sources telling Bloomberg the Democratic National Committee is considering formally nominating President Biden as early as July 21. The party had already planned to nominate Biden before their August convention. There's conversation now that accelerating this is a big benefit because we can put to bed this idea that we're going to change the top of the ticket.
What's interesting to me, and it's something that a lot of different political commentators have said, is that Joe Biden questions around his with itness, I'll just say.
Is that what we call it?
Yeah, I mean, I don't really know what else to call it, have been percolating and baked into the polls for quite a while. And if that's the case, there are going to be people in the Biden camp who say he still has a chance to win, especially people who are close to him who will remain in power should he be reelected. Ultimately, that seems to be part of what's behind some of the reluctance to basically give in to a host of pressure to maybe pave the way for somebody else.
Compare and contrast that to what we're hearing from market participants and the way they've been seeing developments in the bond market. They see things very differently. That Thursday night was this major game changer. And we said on this programme yesterday, Friday felt like the first trading day of this campaign in 2024. It was like the first day where you felt like people weren't just thinking about trades, they were starting to express them
partly because it raised this question of a sweep. Who's going to come out during the election? How do you get turnout at a time where there isn't necessarily enthusiasm for either candidate? How do you raise that enthusiasm down ballot? And that, I think, is really the key question for a lot of people to understand what policies get through.
Yields have been climbing over the last couple of days. This morning, at least, they're pulling back by a couple of basis points. Across the curve, on a 2-year, we're down 2. On the 10-year, we're down 2 or 3 basis points. Another story for you. Barry Diller is considering an offer for Paramount. The New York Times reporting that Diller has signed NDAs with its parent company, National Amusements. Paramount has attracted other suitors, including David Ellison, Skydance Media, and executive Edgar Bronfman Jr. So this has been going on for a while. This stock is up by 3-4%. You were tired of talking about Tesla and deliveries a little bit later. How tired are you of talking about this?
I'm waiting for the special to come out on Netflix about Paramount's purchase plan.
This has been going on forever.
I know. I just kind of feel like at a certain point, how many, different media moguls can get sort of trumped out there to try to buy into this area? At what point is it not a vanity project? Does it become something that could potentially be, highly profitable and consolidate some of the media that we all absorb?
Well, here's another name for you. All right, let's talk about something Lisa's actually interested in. Investors keeping their eyes on this week's long list of potential catalysts, starting with remarks from Fed Chair Jay Powell at 9:30 Eastern. That's just ahead of JOLTS data at 10 o'clock, followed by jobless claims tomorrow. Honestly, there's so much data tomorrow. ADP, ISM, take your pick. Then on Friday, we've got the payrolls report. Mike McKee's with us around the table. Mike, let's get to, say, 9:30, 10 o'clock. What are you looking for?
Well, we're looking for Jay Powell probably not to break a whole lot of ground today because there's still data to come. He's speaking a lot this month, so he'll have other opportunities, including week after next when he goes up to Capitol Hill. So he's probably going to keep it fairly generic and stick to the idea that we have more work to do and we'll make our decisions as the data comes in. At 10 o'clock, the JOLTS number is going to be interesting because it has been something the Fed has focused on, the fact that the labor market was very tight and now it's loosening up. And I've got a chart here that shows what most of the analyst notes I've been getting are focused on, and that's the JOLTS ratio, the ratio of job openings to the number of unemployed people. And you can see how the unemployment rate goes down when the number of job openings is up. This is very logical. That's basically the Beveridge curve. You can see the number of job openings is just about at the level it was before the pandemic. People are saying that will signal, if we get another drop, that will signal that we have finally gotten to the point where the labor market is loosening up.
Does that really give an indication for the Federal Reserve at a time when I remember when people used to say that JOLTS was difficult to really get too much conviction from, and then the Fed leaned entirely on that to make one of their moves? Are we going back to that kind of point?
It's not going to be that the Fed's leaning entirely on it, no, but it's going to be a data point. It's going to suggest that what they see in other labor market data is probably correct. And by that now we're talking Friday and the jobs report and the unemployment level and whether that continues to rise or not.
We've seen a lot of concern about ongoing inflation in services, and there's a lot less concern, obviously, about goods in terms of disinflation there. Is that the reason why nobody seemed to really mention yesterday's ISM manufacturing data, that everyone's looking ahead to other metrics? I mean, does it sort of make sense to you that there's certain things that just don't suck up a lot of the oxygen in the room?
Well, there's a lot of things sucking up oxygen in the room, and I suspect yesterday's Supreme Court decision did a lot of that. We did see, because of the ISM number, that the Atlanta Fed lowered its GDP now forecast for the quarter to 1.7%. Remember, a week ago we were above 3%. Now, that'll change as we continue to go forward into the month of July and we get more data. Markets are probably going to focus more on the idea, and I heard you say this earlier, how fast is the economy slowing down? We know it's slowing down. How fast is the economy slowing down? And is it at a point where the Fed would need to start thinking about taking action to present a problem? And in that case, they're looking to the jobs report and they're looking to the unemployment numbers to give them a sense of how fast things are going.
This started with Yelena Shulatseva of BNP just yesterday. Seems to be a bigger focus on the jobless rate than the actual jobs number on Friday.
I'm sympathetic to the idea that we can't really understand the headline figure because the actual labor force has increased so much. So wouldn't it make sense that you would need a greater number of jobs getting created every single month to just stay stable? It's sort of like inflation, right? The price is different. I mean, it's essentially if the if the population is inflated, the number has to change.
Well, it's been this argument that immigration has raised the number of people who are available to go to work, the labor force. But immigration has dropped off a lot in the last couple of months, and so we're sort of expecting that to go backwards. Friday, I think we're going to see a lot of people bringing up the Sahm rule. You had Claudia on this morning. And it's funny, she said she's not paying as much attention to it right now because of the reason you were talking about, the fact that the denominator rises significantly. But if you look at the Sahm rule in the past, it has always basically predicted recession, or that you're in a recession. And we're very close right now. You need a half basis point move. We're at 0.37. So it would only take unemployment going up to around 4.2% on Friday, which is certainly a possibility for us to trigger that. Now, Claudia says it may not be accurate, but just try to tell Wall Street people. That's why I say creeping closer to a freak out. They're gonna, if you get that 5%, you're gonna have a lot of doom messages coming in.
It is pretty funny that the one person who's not focused on the Sahm rule is Claudia Sahm herself. Mike Maki, thank you, sir. Let's continue this conversation and get to the panel. Joining us now is Point 72's Dean Maki, alongside BMO's Iain Lyngen. Gents, it's great to catch up with you both. Iain, I'm going to come to you first. What is more important to this bond market right now? The economic data that we get this week, or the debate that took place Thursday evening?
Well, over the course of the last two trading sessions, it has undoubtedly been the political tides in Washington and what it means for November. That being said, we have payrolls on Friday, but perhaps more importantly, next week we get CPI again, and that will give the market some very good context for whether or not we'll see that September rate cut. That's the active debate that matters at the moment.
Iain, there's still some banks out there suggesting that maybe payrolls this Friday is more important than CPI next week. Would you take the other side of that?
I would take the other side of it in a consensus print. But if there's a surprise, if you get a 4.2 unemployment rate or a sub 100,000 print for headline payrolls, then all of a sudden the dual mandate employment aspect becomes a lot more relevant than CPI.
Dean, how are you thinking about that trade-off? If unemployment continues to creep higher this Friday, does it take some weight away from the importance of CPI next Thursday?
I think at this point, the Fed really is focused on inflation. The Fed needs to see inflation heading back toward the 2% target. And if that's the case, then we can have a strong payroll report and the Fed will still think about cutting. So I think the Fed's focus really is on the CPI next week.
Dean, how do you understand what some of the data has been saying in terms of slowing but not slow? There is this feeling right now, especially as you look more to the inflation print than you do the labor market, there has been this feeling that we're on the precipice of something that could be more punitive for the U.S. economy. Do you agree? And if not, why not?
I don't agree. I think there's been some mixed shifts within the data that make some of the data look weaker than it really is. So, for example, consumers are shifting away from spending on goods and food services and towards other categories. But those other categories are not included in retail sales. So retail sales looks weaker than overall consumer spending, but markets tend to focus only on the retail sales report. So that's part of what's happening, is that consumers are shifting toward pre-COVID norms, and that's not showing up in some of the data that people are focused on.
Do you agree, Iain?
So I would say that, generally speaking, on the consumption side, I agree. But I am a bit more concerned as it pertains to what's going on in the employment landscape. We do have higher claims. We have the JOLTS quit rate at 2.2%. And there are signs that the Fed has been effective in reintroducing balance to the labor market. But my concern is whether or not the pendulum swings too far in the side of, or toward the side of cooling, and then that starts to perpetuate on itself, and it's difficult for the Fed to address that without some type of policy response.
This is the worry that Claudia Sahm has as well. We had her on the programme with us a little bit earlier this morning. We quoted her before we went into some of her work. I just want to share this quote with you, gentlemen. A good labour market is not a reason to wait. The reason to cut is that inflation is down considerably. A good labour market is what it's at risk if the Fed doesn't move. Dean, how do you think about that framing going into the July meeting at the end of this month, and ultimately when Chairman Powell speaks in about 45 minutes?
I guess I'm a little less worried about the labor market at this point than some people are. And one reason is that corporate profits corporate profit margins are close to the highest level since the 1960s. And corporations are not inclined to do massive layoffs with profitability that strong. Payroll growth over the last 3 months is 250,000 per month. Jobless claims are in the 230s. This still looks like a pretty good labor market to me. What I think has happened is the labor market has normalized rather than weakened sharply.
Iain, this has big implications, consequences for the shape of the yield curve. We came into 2024, we were looking for steepness, but we thought it would be driven by a rate cutting cycle, fueling a rally at the front end of the curve. Can you just put some meat on the bones of this bear steepener over the last couple of days, Iain? How sustainable you think this move actually is? A disinverting yield curve driven by the long end?
So I think that we all know the story. It has to do with the potential of Trump regaining the White House and some of the forward inflationary implications of that. That steepened out the curve. Deficit spending implies greater issuance. So that's why we had a bear steepener. Now transitioning this to a bull steepener, I think will require at least an initial bear flattening impulse as the economic data starts to deteriorate. But eventually, what we'll see is when it becomes abundantly clear that the Fed is about to start normalizing yields or policy rates lower, 2-year yields will drop and they'll price in an extended cycle back to some version of neutral. And so we could easily see a 50, 60 basis point rally in the 2-year sector once the process starts. And that should re-steepen the yield curve and put the benchmark 2s, 10s curve back into positive territory.
So, Iain, do you kind of agree with John Stoltzfus that this is essentially the bond market looking for attention from the Fed?
To a large extent, the bond market is tightening for the Fed at a moment where the Fed is considering dialing it back. So I do think that to some extent, this is a reminder that flows and supply and demand do matter in the Treasury market, but only within the context of the prevailing range. Keep in mind, 10-year yields are still below 450. And this in an environment where the real economy still appears to be on strong footing, at least for the time being.
Dean, you've been in the market for decades trying to analyze the economics of the moment. I would love your insight into how realistic we can be about some of the potential scenarios that are being priced into the bond market, with really Thursday night being thought of as a watershed moment, really looking for the potential for a Republican sweep and the idea of some of the fiscal policies, as well as tariffs, et cetera, put into place. Is that something that you are gaming out actively and think is a bettable type of option?
I think we always want to be thinking about all of the various scenarios, and markets will try to price in what might happen. But ultimately, from my experience, markets don't really fully price things in until the market is pretty sure it's going to happen. So we might see the scenario shift back and forth multiple times in the next several months before it finally settles on what truly is going to happen.
Hey, gents, this was great. Dean Maki of Point 72, Ian Lyngen of BMO, going into Chairman Powell at 9:30 Eastern before we get that first sniff, that scent of the jobs data this week when we get the job openings at 10 a.m. Eastern Time. Equities right now on the screen, negative by 0.4% on the S&P 500, about 43 minutes away from the opening bell. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, you'd mentioned this. President Biden is teaming up with Senator Bernie Sanders in a joint op-ed in USA Today. The two are taking on drug prices, writing this. Let's be clear, it's not just Congress that needs to act. Prescription drug companies also must stop ripping off the American people. Drug makers Novo Nordisk and Eli Lilly are called out by name. The letter also goes on to say that the Biden administration is working on legislation to expand Medicare's negotiations on drug prices. A check on Rivian shares pre-market for you. They're up 1.2%. The EV maker reported second quarter deliveries just above estimates, while it also reaffirmed its guidance for annual production of 57,000 vehicles. Analysts are now waiting deliveries from Tesla due this morning. Bloomberg estimates that the company delivered 440,000 or thereabouts vehicles in the second quarter. That's a drop of 5.8% from a year ago. And the U.S. men's national soccer team has had an earlier than expected exit in the Copa America, failing to qualify for the knockout rounds after a 1-0 loss to Uruguay. The tournament hosts entered last night's match tied on points with Panama in Group C, but their loss, coupled with Panama's 3-1 win over Bolivia, saw the U.S. knocked out. The tournament continues tonight with Brazil meeting Colombia at 9 p.m. Eastern. And that's your brief, John.
Danny, thank you. Thanks for this morning. If I ask you both, How many people in this country do you think know that that is being hosted in this country right now? That some of the best football players on the planet are in the United States?
I would say I'm biased, and I am not able to answer that because I am surrounded by people who might have other interests.
I don't think that they've done a very good job.
No, it hasn't
really
been
marketing
publicized
this at all, right?
People who know football, soccer, know, but the average American.
I've heard more about the cricket in the last few weeks than I have this.
Okay, but I come on this set every day and hear about plans to get tickets to these games. So I'm just saying, I am definitely a biased.
We got to broadcast
commentator.
live with her.
Yes.
When the World Cup.
I'd like to think it's going to be a better effort in 2 years.
Yeah,
Let's put it that way, for 26, for the World Cup. Next on this programme, we'll set you up for the day ahead as we count you down to the opening bell, about 41 minutes away. This is Bloomberg. Equities right now on the S&P 500, negative by 0.5%, counting you down to the opening bell. Here's the trading diary for the week ahead. Fed Chair Jay Powell speaking at 9:30 Eastern from Sintra, Portugal. JOLTS job openings data coming at 10 a.m. on Wednesday. Absolutely stacked because we closed on Thursday. We'll get jobless claims, ADP, ISM services, all of the above. Then on Thursday, of course, we close, but there is a UK election taking place. This week's so busy. On Friday, the big one, payrolls. Lisa mentioned the median estimate in our survey, 200K. Looking ahead to the payrolls report on Friday. With us around the table, I'm really pleased to say, is David Rubenstein of the Carlyle Group and host of Bloomberg Wealth. His latest interview is with Josh Friedman of Canyon Partners. You can watch that on Bloomberg TV at 9 p.m. Eastern Time. David, good morning to you. Looking forward to this one. What do we need to know about Josh?
Josh Friedman was a poor boy, or I wouldn't say a poor boy, middle-class upbringing, Boston, went to Harvard, Harvard College, Harvard Business School, Harvard Law School, top of his class every place, Marshall Scholar, degree from Oxford. And then he went to Goldman Sachs with that kind of pedigree. You're not surprised, perhaps. He then went to a place that wasn't as well known as Goldman, then Drexel. And at Drexel, he was there and very, very smart person, but then Drexel imploded. And so when Drexel imploded, he started his own firm with his Harvard Law School roommate, and they built it into a gigantic credit shop called Canyon Partners, which has done it very well. It managed about $26 billion now. A Japanese bank just bought a big stake in it, a Japanese insurance company, and they're in very good shape. They've given spectacular returns to their investors over many years in credit, principally. And he's a very, very smart person, and I had a chance to spend some time with him recently, and I can see why he's done so well. Very, very analytical, very smart, knows the credit business quite well.
It's going to be wonderful to watch. I'll be watching, and I can't wait to see it. I'm going to shamelessly switch the topic just slightly because we've been talking about the Celtics, and we've been talking about how the value is quite high, and the owners are selling it. We don't have Steve on the show, Steve Pagliuca, to really respond to this, but we wanted to ask you, is it sort of peak valuation? Is it time to sell some of these teams?
Well, they've owned that team since 2002, so it's been more than 2 decades. So not surprising to sell after 2 decades. Clearly, they paid a much lower price. I think they paid low 300, mid $300 million for it. Today, I suspect the team is worth $4 to $5 billion, maybe more than that, maybe $5.5 billion. New teams that are going to come into the NBA with no players are probably going to go for $4 to $5 billion. So a team that already has a championship quality team there probably will go more than $5 billion, I guess. So it's going to be a good payday for those investors. There are many investors who went into it. So after 2 decades, I don't think you can fault somebody for willing to sell their team.
Well, I guess the question is, would you be willing to buy into some of the major league, not just baseball, I know that you did, but some of the valuations that you see out there currently being floated?
I would rather buy at a lower valuation than some of these prices that people are offering today. But, you know, I did pay a fair bit of money for a baseball team. When the Orioles came to Baltimore in 1954, the purchase price was $2.2 million. And we paid, you know, over $1.6 billion. So prices do go up. And there's no evidence of anybody buying sports teams in recent decades losing money on it.
David, this was great. And I will say, just to promote the programme, and again, looking forward to David's interview with Josh Friedman of Canyon Partners, Bloomberg TV 9 p.m. Eastern tonight. Do not miss this a little bit later on. Tomorrow on this programme, just a promo for you, James Athey of Marlborough Investment Management will be joining us, Kit Jukes of SocGen, Jordan Jackson of JP Morgan Asset Management, Mark McCormick of TD Bank, with lots of questions about the election and what it means for this bond market, particularly the bear steepener we've seen in the yield curve over the previous 2 days.
Can I just say, especially after talking to David Rubenstein, it sounds a lot more fun to dance at an Orioles game as the Orioles are in first place than betting on the macro trends in the market right now. That's all I can say. Is that sounds like a lot more fun.
Change your career? Is that what you're asking for?
I think I want to invest in it, some sort of professional sports.
We can have a little chat with David in just a moment.
I think I will.
All right. From New York City, the opening bell about 35 minutes away.